Ron said, that the preeminence of the US dollar gives the United States enormous runway and latitude to be very patient about how this is managed. But ultimately, there are only a handful of ways out of this, especially if we continue on the same fiscal path. And so, you can run a more aggressive growth strategy. And if you run a more aggressive growth strategy, that can compensate. I think people are watching this. I don't think we're at a place where there are alarm bells, but I do think we've grown the debt stack in the United States very significantly. We've kind of grown it 4.5 times in the last 15 years. Just refinancing the current stack at today's levels continues to grow it through the rest of this decade. I think we've got a lot of latitude given the preeminence of the US dollar. But at some point in time, there'll be some event that creates more focus around this if we don't create a growth strategy that allows the current trajectory that we're on to rebalance in some way, both a growth and spending strategy to allow it to rebalance.
Okay, very good. And for a reason, I'm not putting this question to Mark, but if you volunteer to answer it, I don't mind.
I was so happy to see Ron on the hot seat here.
Okay, perhaps I turn to Ted for a question that's slightly different, but a related question. And I look at my record, and I find out that you say a couple of times that we are seeing the end of financial repression. Now, when you said that, what was the most important market shift that you had in mind when you keep mentioning this? And now with the general expectation about the US fiscal situation, very little political appetite to really contain the deficit. And on the other hand, a few inflationary factors seem to be coming up and going in force, like supply chain rewiring, climate transition, and higher military spending, and aging population. Now, are you worried that some form of financial repression would be creeping back in with inflation moving up faster than short-term rates? And how should firms like Morgan Stanley position themselves for such changes?
I think that was Ron who said that. Well, we had 15 years of zero rates and zero inflation, and something was going to happen eventually to take us off of that. And that event, of course, was the pandemic, 5 years next spring, and then the remediation and the stimulus, and then, of course, the unleashing of populism that came on the back of that. And you're right that there are ongoing inflationary themes that bear consideration. Some element of deglobalization, ongoing climate transition, the muscularity of the nation state or regional alliances, i.e. defense, war, those are all inflationary. And it is also the case that there are 3-4 years of a cohort in the US that never actually received the stimulus but received the inflation. And then there are others still who drew down on their stimulus and are not asset owners, and so they need to be minded as well. So in a sense, there is an inflationary backdrop, and there is now the additional complication of the potential for tariffs, and actually net emigration also would be inflationary. But we have to put that against the reality that the consumer and corporate community, by and large, is in very good shape. The economy continues to grow, and that is a good thing. And the reality is that the bond vigilantes are out there, and they will be looking at the long end, but we should bear in mind that the long-term Fed funds rate for the last 80 years or so is about 4%, and it would not be unreasonable to think that terminal rate could be 3 to 4%. So the Fed might well be bearing that in mind as something that is normalized. I think when you put all of that together, the hot and the cold, there is enough there to conclude that the idea of going back to financial repression, if that means 0 and 0, is highly unlikely. What is that terminal rate? We'll see, but if we continue to grow, 3 to 4% is not a bad place to be. And for for the Fed to move prudently, given that there will be hot and cold prints, is a smart thing to do. With respect to our business models, we raise, manage, and allocate capital, and this environment has been one where if you are in the business of allocating capital, it's been great for our markets businesses. A normalized economic environment with some level of uncertainty and some level of cost of capital, that's great for allocators. And then if you're managing capital, cash, for example, you saw that there's $7 trillion now in U.S. money markets. Cash is a strategic asset at 4.5% or 5%. So the managing capital business in our wealth and investment management business is good. And what we're most excited about as a group is the idea that we're going to get into raising capital mode. That is the last piece of what is the hallmark of a growing and thriving economy, which is where the classic underwriting and mergers and acquisitions businesses take hold. So if you think about that against the big picture, I think financial repression is behind us, and we'll have more normalized economic conditions. And yes, the bond market is a daily check on hygiene at the sovereign level, and we'll all be watching that. But for now, it looks like a growth plan is starting to take hold, and we should, on balance, be bullish about it.
Yeah, well, thank you very much, Ted. Now, I now turn to David. Given the macro backdrop that we just talked about, what are you seeing by ways of financial market activity in the U.S. and perhaps other regions, in particular in Asia?
Financial market activity in terms of capital raising activity, or?
Yeah.
Yeah, so the capital raising activity in the U.S. and around the world has been muted. You know, we had an extraordinary dislocation coming out of the pandemic, and with a massive amount of fiscal stimulus, we basically took capital raising activity, market activity, to kind of peak levels in 2020 and 2021. And then with the war in Ukraine and a reset with inflation and a reset of values, we slowed that all down. And so for the last couple of years, if you look at M&A activity, if you look at equity capital markets activity, we've run meaningfully below 10-year averages. M&A activity this year has run a little less than 15% below 10-year averages. I do think there's been a regulatory overlay to that because the FTC in the United States has had an implication on those activity levels. And I think equity capital raising activity has run about 24% below 10-year averages. Debt capital markets activity this year picked up meaningfully and has run above 10-year averages. And given where we are at the moment, spot, you're starting to unleash some of those animal spirits, and you're seeing a pickup in equity activity, pickup in M&A activity. I would say with the new administration, we'll have a different FTC. You know, all of that, I think, in 2025 should contribute to more robust levels of both capital raising and M&A, which is obviously good for the ecosystem that everyone here sits in.
Yeah. Okay. And now I would like to stay on with David, but having talked about the macro thing, I would like to move on to a little bit to talk about like what I foreshadowed at the beginning, a structural market shift. Now, as non-bank financial firms like Jane Street and Citadel Securities are emerging, and significant challenges to traditional investment banks in market making. They are taking a very, very big share of the business and growing fast. How do you see this shift affecting the competitive landscape for firms like Goldman Sachs? And perhaps Ted would like to supplement as well from Morgan Stanley's perspective.
Sure. You know, all of us on this stage have been in these businesses for a long time. Just start by saying these are super competitive businesses. They've always been super competitive businesses, and they will continue to be very competitive businesses. You mentioned Citadel and Jane Street. They have interesting businesses. You know, I'd say their focus, particularly in equity markets, on what we call anonymized flow, and the technology they've put behind that has allowed them to have very significant market share in those areas. There are certain regulatory arbitrages that exist that have allowed them to invest in game focus there. But at the same point, those are narrow aspects of the overall ecosystem that firms like Goldman Sachs and Morgan Stanley participate in. That would be interesting. Goldman Stanley, a little bit of a merger there.
I was thinking Morgan Sachs.
Wouldn't surprise you, I was thinking of Goldman Stanley. But firms like ours run very, very big, complex ecosystems where we bring, a wealth of products and services that are necessary for big institutions. And, I think, and I look at our focus on our clients, our ability to finance our clients, our global reach, our scale. We've had significant market share gains. I think we've taken our market share in those market activities up by about 350 basis points over the last 5 years. These large platforms are very capable of competing and will continue to compete. So there'll always be competition. There's always change. Technology advances change. But I feel, really strongly about the value proposition that a big global organization like Goldman Sachs can provide our clients.
Yeah, I totally agree with that. Scale and global, you have to be. To run an equities business, there are three of us that have about, 60% of the top line. Just to run that business costs $4 or $5 billion a year, even before you turn the lights on. So you need global scale. And then when you look at emerging pockets like private credit, there's plenty of room for us to interact. The relationships may get more complicated at times, but our ability to source, structure, finance, manage that capital is profitable. And again, if you have the right kind of scale and resourcing, you can do it successfully.
Yeah, well, I heard you mention private credit, so this is something that I would like to touch on as well. Of course, when we talk about private credit, everybody thinks about sort of Mark and Apollo. Now, we heard a lot of these suggestions that private credit managers are really taking the lunch of traditional banks as well, and with the booming private credit market and regulators around the world, many of them also are concerned whether this is going to cause a systemic risk to the financial system with the growth of private credits being less regulated, less transparent as compared to banks lending. So, so I wanted to see your take on this, and also for Apollo, while people say that you are taking the lunch from banks, you are having some collaboration with certain banks like Citi and BNP Paribas. So do you see them as friends or frenemy, or so what's your take?
So first, I consider the bankers to be very smart. So it's not just 2 banks, it's actually 12 banks. And it'll be 15 banks by the end of the year, including partnerships with many of the people here. And so we have found commonality of interest. And what's been interesting to me is the discussion with global regulators, because I think that's actually a more interesting way to come at it. We all grew up in an environment. I look at the kind of experience level in the room rather than saying age. The experience level in the room. And we grew up with an innate belief. We think private is risky and public is safe. We know in our bones that's true. And 40 years ago, which is how long ago I started, it was true. Private was 3 products: venture capital, private equity, and hedge funds. All risky, but also all in the right way, used perfectly. And public was 8,000 public companies, diversified portfolios of stocks and bonds. But what if our belief that private and risky and public is safe is just wrong? Then everything we've done in asset management for the past 40 years probably needs to be revisited. Because when something's risky, you stick it in a little bucket. You call it alternative. You watch it carefully. You want really high rates of return. But if private is safe and risky and public is safe and risky, why do we think they're any different? And the answer is it's just change, and regulators are being forced to actually address this right now. So in the US raises 50% of the world's capital. It has the most diversified funding markets. We have public markets, we have private markets, we have bank markets, et cetera, et cetera. Everywhere else in the world is pretty much limited from a capital raising flow. Europe is being forced to confront this in a major way. The Draghi report points out some of the more obvious holes in the market. And we find ourselves in an interesting dialogue now with particularly European regulators. How did they start a private market? How did they get private investors off the sidelines? And the intersection of what we do with the banking community is going to find its own level. Banks are amazingly good at some things. In asset managers, particularly long-dated asset managers like ours, good at certain things. We found our accommodation with the banking system. I think it is the regulatory landscape and the public's view and the participants' view of public and private that needs some updating. And some of the things we're doing, particularly with Ron, actually are going to call the question. I think 18 months from now, investors broadly will not actually talk about public credit and private credit. They're going to talk about credit. They're going to talk about whether something's investment grade or below investment grade. I actually don't think we're going to know the difference between public and private in 18 months.
18 months, so now, maybe you're right, but the fact that people keep asking these questions means perhaps we need more information, more education, or whatever. So, because lack of transparency or less transparency or more opacity naturally means that regulators or officials feel a little bit uneasy. So, is it something that we can do more to sort of make everybody a little bit comfortable with that?
Well, I would say the following. If most places I go when I speak with regulators, almost everyone grew up as a bank regulator. Their knowledge base is as a bank regulator. Their information sources are as a bank regulator. From an investor's point of view, from a public markets point of view, banks disclose two lines: loans to customers, loans to companies. You click on John's website, my website, you get every holding every quarter. And so we start with a set of assumptions that private means less transparent that are just false. It's just the information is located in a different place. And so I put it back almost as a question the other way. What is the actual difference between public and private? It's not the size of issue. It's not the issuer. It's not the rating. It's not the provision of financial information. It will not be the trading and the price transparency, because new news, there is no trading in fixed income, public or private. We have the illusion of price. We don't actually have price. And what's happening is all of the tools that exist in the public market as it relates to fixed income are coming to the private market. And I think very quickly investors are going to be confronted with the fact that what's different is something in their mind rather than something that's real.
Howard, I just want to pick up on the first part of your question where you said that the bank regulators are concerned about the rise of this phenomenon. I would argue that the bank regulators have gotten exactly what they wanted here. Coming out of 2008, there was this view that banks were enormous concentrators of risk. And we saw what happened with the bank failures. And what they've done through various re-regulation capital rules is they've taken a lot of that risk out of the banks. They've basically unenabled banks to lend as much as they can. And what you've got now in private credit is actually a distribution of risk. It is not concentrated in institutions. It's not to say that there are new risks arising, but bank regulators have gotten exactly what they wanted in terms of less concentration of risk in banks and distribution of that risk more broadly.
Okay, thank you very much. That's very helpful. Now, I'm now turning to John. Of course, you have your credit strategy, but I'm not going to ask you about credit. Of course, ask you about commercial real estate. That's another sexy subject. Now, I remember that you talk about the headwind at the summit last year for the real estate sector. And we also had another fireside chat, I remember very clearly. You told me that we can fall in love with everyone, we can fall in love with everything, but don't fall in love with our investments, including our real estate investment. So we need to cut it when we need to. But in recent months, you reiterated that investor should invest before signs are all clear, so you really think that it's time to really mend relations with our old love here?
Yes, I think you should rekindle your love with real estate. And I would say going back in January, we said publicly we thought real estate was bottoming. We've invested now, over the last 12 months, $30 billion in the space, which is a reflection of our very high conviction here. And the question is why? And I'd say first it starts with underlying fundamentals in real estate are pretty good in most of the sectors, in logistics and rental housing, where we focused our investing. Vacancy rates are 5%. Cash flows have continued to grow, even through this difficult period, albeit at a slower rate. Now, the office sector, as we know, post-COVID, has had a lot of challenges. But the rest of the commercial real estate market has generally held up. What hit the market was a sharp increase in cost of capital. Base rates went up, spreads widened a ton, cap rates or unleveraged yields on real estate went up, and that caused the decline in value. And if you look back about a year ago, things sort of reached their peak in terms of negativity in real estate. And since that time, we've seen total borrowing costs probably drop 35% or more. We have seen the commercial mortgage-backed securities market reopen. It's up fourfold over where it was a year ago. Transaction activity's picking up. There are 2 or 3 times more bidders showing up at auctions. That's obviously positive. And then longer term, real estate's about supply and demand. And you've seen new construction and things like warehouses decline, new starts decline to 80%. And that creates a foundation for the ultimate recovery. So I think for investors, it's hard because there's still a lot of bad news in the system. They've taken losses, and they tend to want to wait for that all-clear sign. But if you went back to the financial crisis, you wanted to start investing in real estate in 2009. If you went back to the early 90s and 92, those couple of years coming out were when you saw the best returns, where you're still feeling a little more uncertain. And I would say today we're in a similar period of time, so we choose to lean in.
Right, right. So do you see different pockets or different verticals in the kind of a real estate sector that you would particularly like or less like?
Well, as I said, you know, the fundamentals in logistics driven by the move to e-commerce have continued to be strong. We like that on a global basis. We're the largest investor. Rental housing, since the financial crisis, we have had a real shortage of building. It's one of the issues in most of these developed market elections is the shortage of housing and the cost of housing. And that, of course, has translated into pretty good rental growth. And I think coming out of this, again, new construction's come down, so we still like that space. The hotel business, again, people are going to travel. We've seen less construction there, so we're bullish. And then in the office sector, I think you've got to be a little more selective, given the capital needs and the underlying vacancy, but maybe buying some of the best buildings at favorable prices, maybe through debt, that could be attractive. So I'd say we generally see the landscape is pretty good at this moment. And of course, in 2 or 3 years, it'll be less good after you've had a number of good years of returns and more capital will pour in.
Well, I drew on this one more point and then open up to see whether other panelists has other view as well. Is you didn't mention AI's kind of a data center. You are sort of putting big money into this data center, but now it's an AI craze and then everybody putting a lot of money in it. But some people say that, oh, the monetization model is still pretty unclear. So do you think this is too much money into it? Is it a bubble going on?
Yeah, I should have mentioned data centers. That is our biggest theme across the entire firm. It's really the physical manifestation of the digitalization of our lives. If you think about data storage, if you think about cloud migration, and of course AI, it happens at the data center. That is where those GPUs sit and communicate with one another, and the needs for compute power are enormous. And so we have gone out and now have $70 billion of leased data centers, a pipeline of another potential $100 billion we could build. We're doing it in the US, in Europe, in Asia. We're doing it in equity. We're doing it financing. We continue to be quite bullish. I think the real question is this like the railroads in the 1880s in the United States, where there's a great underlying trend of demand, but it's going to be swamped by new supply, which kills the returns? And I'd say in that regard, there are two protections. One, you don't go out and speculatively build a data center like condos in Miami, because there are only 4 or 5 tenants leasing, and the cost of these centers is quite extensive, and you have to customize in many cases. So it's $1 billion. So we're not seeing the kind of speculative building that kills returns. The second thing is that we've got a global shortage of power, and that is going to become more and more acute as we electrify everything. First with these digital assistants and AI, and over time with robotics. And when you go out today to build a data center, in many places you can't. And so if you're a developer, you have the know-how, the zoning, and of course the access to power, you're in a unique spot. So this is a space we like a lot, and we will continue to be all in as it relates to digital infrastructure and data centers.
Yeah, yeah. Yes, Mark, you have anything to add on this topic?
Look, I think John certainly has identified the trend, but I'll simplify. For us, data centers is one real source of demand. Energy. In the US, we're talking about energy transition, but we're now talking about energy accretion. We're going to build lots of power. We're building infrastructure. There is so much demand for capital. I think of this in terms of debt and equity. There are just so many underlying drivers. In some of the markets, I think you want to be debt. You're concerned about overbuilding. You're concerned about pricing. You're concerned about tenancy. In other of the markets, I think you want to be equity. I think what we're watching is what I'll call this, global renaissance or industrial renaissance that is taking place. And the factors are not just the newfangled data centers. What's going on is nothing short of extraordinary. I mean, people forget the last 3 years in a row, the US has been the largest recipient of FDI. It likely will be again this year. Massive amount of building. 3 years ago in the US, we allocated money for infrastructure, all under construction. 2 years ago, $52 billion of semiconductor subsidies, not a single plant open yet, all under construction. A year ago, Inflation Reduction Act, $1.3 trillion, everything under construction. Defense, ramping up. And so what we're watching is just this incredible demand for capital happening against a backdrop of a US government that is running significant deficits. And so the capital raising business, I think that's going to be a good business.
Okay, that sounds very good to iBanks now, time is running out, so I would like to put my last question to Goldman Stanley
Goldman Stanley.
Yeah. Now, talking about Asia, and we saw a round of stimulus announced by the mainland authorities in September, and we saw very strong rebounds in the equities market in mainland China, but subsequently it's tamed down a little bit. Today, we heard some positive remarks from the Vice Premier, and we heard the statements by the main regulators in mainland China. So do you think investors would feel more assured, or if not, then what do you think investors would like to hear more from the mainland authorities before they regain a stronger confidence in Chinese assets? Maybe David, you go first.
Sure. I think you've got a combination of issues that have global investors, predominantly on the sidelines with respect to capital deployment foreign direct investment into China. And if you're looking for, messages that can assist, certainly some of the messages today are helpful about the continued opening up and the continued, transition. But when I listen to global investors, one of the things they continue to be concerned about is they've put a lot of capital in, and it's been very difficult over the course of the last 5 years to get capital out. And so in that context, I think messages around the ability to both attract capital and have capital come in and come out are very, very important for global investors. And I think also the context of more confidence in the stability of the economy. There are a lot of things that are going well in the economy, but seeing improvement in consumption, the stimulus was a first step, but seeing improvement in consumption in the economy, I think, is going to be very important to win back some of the confidence of the broad national investing community.
Thank you. Ted?
Yeah, I agree with that. Transparency is important. And battling deflation takes time. And so the monetary impulse is starting to take hold. Lower interest rates, more attractive mortgage rates, inducements to new ownership. The fiscal piece will take time. The real estate dynamic is going to take a number of quarters, and clearly there's focus on that. We should bear in mind, too, that 30% of disposable income is held in savings, average household in China. So that is a very strong number, and clearly the name of the game here is to reignite consumer confidence. And that's something that takes a while to take hold, but we're seeing some green shoots.
Can I mention one other thing I wanted to mention? Capital markets are hugely important. And, continued progress in the opening up of the capital markets is hugely important. It's a huge advantage for the United States. The more you can broaden capital markets, the better in terms of ultimately that cycle of capital deployment, capital investment.
Yeah.
Second largest economy, second largest market as a liquidity matter. We all have many people in Hong Kong. We have 2,500 people. It's a great business to interact, and once that confidence starts to build, then the capital will move.
Yeah, absolutely. And that's why Hong Kong, HKMA, and all the Hong Kong government and all the regulators in Hong Kong really want to continue to build Hong Kong as a platform to facilitate the capital market efficiency for mainland China, mainland companies. This is the role that we are going to play. Thank you very much. Let's put our hands together to thank the panelists for a great session. Thank you very much.
Thank you, all panelists, for an excellent panel. Please stay on stage for a photo. We'll take 2 sets of photos. First, in the middle, to our official photographer, please. Please stay for another set of photo to your right after the middle one. Please stay for our photo to the right. Our media friends over here. Thank you very much. You may now return to your seats. We'll now take a short break. Please be back by 11:20. And please enjoy your break time. We have coffee and refreshments at the foyer area. Thank you very much. The next session will begin very shortly. Please kindly take your seat. Thank you very much. Welcome back, everyone. Hope you enjoyed the break. Our next session is going to be on AI and digitalization of finance. AI and the digitalization of financial services is reconfiguring the way financial institutions operate, bringing a variety of benefits as well as new challenges. Our next panel will take a closer look at how to navigate the increasingly complex intersection of technology and finance. Let's welcome our moderator, Julia Leung, from the Securities and Futures Commission, and our panelists, Mike Gitlin from Capital Group, Jenny Johnson from Franklin Templeton, Danielle Pinto from JP Morgan Chase, Peng Zhao from Citadel Securities. Julia, thank you.
Thank you. So I finally got your attention. Now I'm glad to lead this discussion on two of the most exciting topics to shape the future of finance. Now, as we all know, technology is not new. It has been a driving force for changes, the way that portfolios are being constructed, the way that deals are being made, creating new opportunities in enhancing efficiency and customer experience. But recently, the pace seems to be picking up with generative AI and digitalization, which seems to have immense potential to further accelerate that change. However, with these, they also come with risk. And new risks have arisen, and there's even talk of existential threat to human. So we must ensure that technologies are being responsibly adopted and safely adopted. And that's, for many firms, it could be cash burning as well. So today I'm very pleased to be joined by four very prestigious panelists to shed lights on how technologies are changing and reshaping the financial services industry. Now, speakers on these panels have a tendency to market their services. I would do the same for our circulars and our regulatory framework. Now, just last week, the SFC has provided guidance to the industry about the deployment of generative AI large language models. While we encourage licensed firms to be using that technology to innovate, to raise productivity, but at the same time, generative AI amplify existing risks, and we should be more cautious about. So what we are calling on licensed firm is to take a risk-based approach in your deployment and in areas covering senior management responsibility, AI model risk, cybersecurity, data, and third-party vendors to be a little bit, pay a lot more attention. For digitalization trend, Bitcoin may be surging past 90,000 US, but and where it is heading is not our concern in this forum. We will be looking at the bigger picture of digitalization and tokenization of assets, from bonds to money market funds, and how the financial markets can benefit from it. SFC and the HKMA are working closely together to scale up the tokenization markets and expand the use cases. And for that to happen, there's a need for an enabling and interoperable blockchain foundation layer and a coherent rule book on blockchain-based financial services. And this is what the HKMA's Assemble Sandbox is doing, and there are recent fruits coming out of that sandbox, like tokenization of money market funds by local bank using tokenized deposits. So in this process, we try to identify issues, particularly regulatory hurdles, and provide clear guidance. And we do expect that it's only with clear guidance from regulators can we see the convergence of DeFi and TradFi, with the latter providing the much needed trust and compliance in the Web3 space. So let me kick off by taking the first topic on AI. And to start off, I would ask each of you a question to rate your firm's use of AI from 1 to 10, with 10 being the highest. Now, this is not a competition, so you don't, because you are in totally different areas, just describe the areas of application, but more importantly, to see where your firm is 3 years from now in the use of AI. I'll start with Mike.
All right, I wish 35 years ago at university they asked us to give our own grades. I would have done a lot better. Look, I think it's impossible to give a numerical rating on something where you don't know where the finish line is. And the finish line, when you do think you know where it is, will continue to move. The way I think about it from a capital group perspective is we use technology for 3 reasons, right? 1 is to make our business more efficient. 2 is to service our clients better. And 3 is to generate better investment results. On the first one, and we just use real examples, on the first one, I sent out a message to our 9,000 associates called 30-30-30. And it was, please reduce the number of meetings by 30%, reduce the number of people in the meetings by 30%, and reduce the gold-plated PowerPoint presentations by 30% so we can be more effective. So how do we do that? In our Teams system, you can be late to a meeting and hit a button that says catch me up, and it catches you up. Or you can entirely miss the meeting and let the other 10 folks carry on and get a summary and action items for yourself on what you needed to do coming out of the meeting. If we save 30 minutes for every associate a week, we would save 14 million minutes a year just by being willing to miss 1 meeting once a week for 30 minutes. So you see the scale you get from something like that. In a client-facing role, we use PrepMe. And PrepMe means as you go out to spend time with clients, what are the 20 or 22 inputs about the client that would make the meeting more effective for them, not you? And that technology is very helpful. And then in the last one for our investment group, we have something called Blue Team, Red Team. Assume we are large owners of Netflix, just as an example. Much greater than any benchmark, much greater than competitors. The other, what we use technology for is to create the bear case. So we don't live in our own echo chamber. And then one of the analysts takes that AI-generated bear case and conducts a debate with the folks who are the largest holders just to challenge our assumptions. So just trying to bring those examples to life on how we use it.
Okay, you refuse to grade yourself. So Jenny.
Well, because Jenny will have a higher grade, so I knew she was going second.
No, because I agree with your point, which is, what's the scale? Like, I'm pretty sure everybody here has been using machine learning in their, company for a decade. So if you want to measure that, we'd all rate it really high. So I asked, our Franklin Equity Group is housed in Silicon Valley, and the CIO is an engineer and with a tech background, and he's the one driving it so much through the firm. He literally, in a meeting, grabbed from the tech guy to show the other investment people what you can do with Quarter Pro and Perplexity and some other tools. And he rates it a 3. And I was thinking about that, and I thought, he's focused on it all the time and pushing his team to be thinking about the efficiencies that they can, not cost efficiencies, but time and information efficiencies. And I was thinking, you know what, if I come back next year and you ask the same question, we will have done a whole bunch of stuff, and I'd probably say it's a 3. Because the problem is that we're just starting to open up what the opportunities are and how we're thinking about all of us as an industry. If you look at technology innovation, the first thing that people do is they just make more efficient and improve the things they do today, because they can't yet envision what the technology ultimately will do on the disruption side. And you have to get your teams comfortable with using the technology before you'll actually get to see what those true disruptions are. So I think that wave hasn't really hit us yet. And then I was thinking about my operational areas, and we have some great stories, great examples of where we find efficiencies. But then I started to think about all the service providers in this room and how they're going to have all these efficiencies, and what do I need to do in my contracting to make sure that those appreciate. Daniel, over to you.
Thank you. So AI has been a 10-year journey, so traditional AI. And on that, we have many, many use cases on automating reconciliations, credit decisionings, embedded in trading algorithms, fraud, and fraud detection, and fraud avoidance. So that is being, and from research to center of excellence to embedding it in each of the lines of business, that has happened, and it will continue happen. So instead of giving you a rating, I will give you numbers, real numbers of JP Morgan. So we do measure the impact of all this. And the impact for last year was around $1.3 billion, either cost avoidance or increase in revenues. And this year will be around $2 billion, a big increase. And $2 billion is a lot of money, but the top line of JP Morgan is $170+ billion. So you can argue that all that we have done is increase productivity, but a bit over 1%. But I think that we are at the very, very beginning, and the confluence of traditional AI and large language models, they are going to really change and going to be a big, big productivity gain. And I'll give you one example. 2 years ago, we asked one of our PhD experts in artificial intelligence to look at one of the operational processes, that is know your clients, KYC. In 2 years, by automating, going through processes, applying automation through AI, and we haven't yet touched large language models, the cost of processing a file has gone down by half. And I think that in the next 2 years, it will go down by another 2.5. So going forward, so large language models that we are at the very, very beginning, I see 3 phases. First, you give the people the model that comes out of the box, and you will have some marginal productivity. Then you move into really knowledge experts, where you complement the models with the knowledge of the company, and then you can do calculations, you can do data inquiries, more related to the company and things like that. It will be some more improvement in productivity. And the third will be agents that we're really going to see the big improvement in productivity. So in the next 3 to 5 years, for me, the biggest impact will be towards productivity, a lot more of top-line growth. And that will be in operations. That is like 50, 60,000 people across JP Morgan. Efficiencies in data, in global call centers, and technology developments. I can see in all these 3 a massive improvement in productivity as we continue deploying, reviewing processes, continue to deploy AI, and deploying large language models in percentages that it could be very, very substantial.
Thank you. Peng?
First of all, thank you for having us here. Fall in Hong Kong is one of my favorite times, and there's always an excuse to come back to Hong Kong this time of the year because this wonderful event you'll organize. So I look at the question a little differently. I think from our vantage point, one of the critical things that we focus on is in which areas we want to work and strive to be a 10, and in which areas we want to work and strive it to be a 0. So knowing which areas we expect the highest amount of return from the investment in AI and automation in general, and which areas it likely turn into a giant science experiment, the waste of resources has been the key focus for myself and my leadership team. Certainly in some areas where it involves gathering a large amount of data, information retrieval. AI and large language models have brought in a higher quality level of processing power that we've been seeing in the last few years, and there's a real acceleration here. Keep in mind that we have about 1,600 people, but we transact somewhere around $500 billion of daily transaction across more than 50 countries. So anything that happens anywhere in the world, and it could be in languages no one at the firm speaks, if it moves the market, if it moves the instruments that we need to transact in, we have a desire to know that. So a lot of these technological breakthroughs in natural language processing, large language models have increasingly allowed us to retrieve data, process it, model it, and understand it on an increasingly automated basis as well. So the approach we've been taking is really look into what are our most important workflows, and how do we get better at that, how do we get more productive and efficient at that, or the most pervasive workflows. For example, we often joke that the most commonly spoken language in our company is C++. So getting our developers to write code more efficiently would be one of the most common workflow we have around the firm. But we try to not get stuck in between. If we don't pick an area as an area of focus where we're going to deploy, we try to not touch it at all. So very top-down, lay out different areas, and figure out where we want to get to a 0 and where we want to get to a 10. So I don't know how you weigh the 0s and 10s and get up to an average number, but so far I think we've been doing a pretty good job.
So it's either 0 or 10. So which area we get a 10?
Again, in areas of our core competency, retrieving data, processing data, making sense of it, to figure out how to get to a good price and quickly and efficient way, how to facilitate these transactions in the most seamless, error-free fashion, we will always strive towards a 10. And by the way, a lot of times that just takes good old-fashioned automation. It doesn't always involve Gen AI, large language models, or at all. Those are tools at our disposal, but just because we can use those tools doesn't make them the best tools possible. Yeah.
This is a very good excuse to look at every process in the company and start at the basis, even forgetting about the AI, just looking at the process and making it efficient, and then automate on top.
Mike, it sounds like our service contracts with JP Morgan are going to get cheaper.
I think you're right. Thank you, Daniel.
Now, I've noticed that it's never a simple question. Only Jennifer answered it, like from 3 to 6. The men in the room have a different, very, very thoughtful responses. Now, I would dive a little bit deeper into what Peng said about the use of generative AI in trading. You've actually laid it out quite well. We've always known that traditional tools work very well in terms of like reducing spreads and enhancing and giving you the data and analytics. But with the use of that traditional technology, we already see a huge increase in trading volume, liquidity, but also volatility. Now, if generative AI is going to do a better job, a quicker job, so are there any concerns that it will exacerbate the trend of herding behavior, which Gary Gensler talked about? Any concentration risk, particularly when the AI model are provided by a few providers right now, and whether they are very similar, driving to very similar trading decisions, and how do you mitigate those risks?
Well, thank you for that question. I actually forgot. I should thank Howard for giving us the shout out on the last panel. It was quite a surprise. But I mean, look, when we started over a little more than 20 years ago, if you look at how a typical investor would transact in the United States, if they want to buy or sell stocks, you need a minimum deposit of $10,000. You got to call your broker every time you want to trade. To make a trade of a few $1,000s, you got to pay $100 in commission, right? And on top of that, if the day after election and you want to rebalance your portfolio, so does everyone else, you may have to stay online and wait for your turn, and you may need to wait for a long time before you get connected and call back again. Today, You need a smartphone. You need $100, sometimes not even. And you have a transaction cost that's lower than most institutions without commission. And all that happened because the tremendous amount of efficiency automation have created. The entire workflow from the moment an order is placed to a moment that order is executed has been automated to such a degree, the cost of executing that and facilitate that went from $100 plus to almost nothing, right? That is a possibility of what technology has enabled. And you look at US household, something like 62% of US household own a stock, either directly or through a fund, right? That number is about 20% for Japan. That number is less than 10% for China. So that really powers the economic development and growth and prosperity of the United States. And so much of that could not have happened without the power of technology, analytics, and automation. Now, there is the concern that some people are asking out loud, which comes in the following form. Can the product be so good that people like it so much, people use it too much? Right? I've never seen the solution to that sort of concern to be, let's make the product worse so that the clients or consumers would use it less. That's never been a successful solution in anything that I've seen. Or the question could be asked in the following form, that is, hey, people didn't quite have transparency. They didn't know what was happening to the stocks they were following or had an interest in. Now they have unparalleled amount of transparency, and the amount of information you can get just by logging onto your app is dwarfs where a traditional or a professional trader had access to 10, 20 years ago. So you all of a sudden could ask the question, could there be herding? If all of a sudden everyone have access to the same information, whether you're a professional trader that get paid $500,000, $1 million a year, or someone who only have $100 in your broker account. The answer is, it's not bad to have everyone to have information. In fact, that's a huge step forward. Transparency is good. But there could be a step too far if we take away the individual's need to make their well-educated, well-informed decision, and we start making decisions for them. Right? That is the fear of what generative AI may do, and then all of a sudden we just tell everyone what stock they should be buying and selling. I think we're pretty far from that. I think a lot of the people in this room run some of the largest brokers and wealth management firms for their clients. I don't think any one of them will tell you, hey, they're ready to have their AI agent to tell their client what stocks to buy or sell without real advice and input. I think we're pretty far from that.
Very good intro into what I'm going to ask Dan about guardrails and risks and whether we are too much reliant on generative AI when we are going down that journey.
So clearly at the moment, no, because we are at the very, very beginning of it. But when you think about the control environment that you need to have around generative AI is by far more complex than what we did for traditional artificial intelligence, where we learn how to analyze the models, we can explain how the model works. We have done a very good job, most of the companies, in managing data and data accuracy and data privacy. So all done for traditional AI, I feel that most of the companies are in a good place. So when you go into large language models, so it all gets a bit more complex because these models have, first you may not have access to the model itself because it's provided by someone else. But even if you were to have it, so it has either millions or billions of parameters. So the way that you have to explain the model is more to the output of the model rather than by the functioning of the model. So these models are still, though they are progressing very fast, they still hallucinate. So there are errors in the models that probably the partnership between us that we are using the models and the one that are generating the models will have to work to improve that situation and reduce that risk, and have models that they are going to control the models or check the models, and we are working in that too. And data is another issue. So we are in a good place, but it's still a long way to go in order to make sure that the usage of data that is going to grow so much is to a quality that respect data privacy, that we don't violate any of the rules there. So when you are using it in quantities by far bigger than we ever did. And then one simple thing also is to train the people. So we deploy large language models off the box to 220,000 people. So now we are training to do the basic things. So these are not the second phase. It's like the first phase of model. So we need to train the people in order for them to be aware of the good things that come from the models and not the so good things that come of the models. And the last one is the work that we have to do with the Microsoft of this world, so all the others, to make sure that we reduce the risk of unforeseen events going forward. And just one more comment on regulations. I think that hopefully all these companies, they are very, very highly regulated. So there is no need to regulate AI, because AI should do what the regulation tells us to do today. So it's about to controlling the risk, and hopefully the regulation goes that way rather than trying to control things that they already massively control and regulated.
Your point taken. We are not regulating the activity, not regulating the AI itself, certainly, but certainly have to look at the risks that generate out of it. And one of the risks is hallucination risk. I'm going to ask Jenny to a live example, because you are also announced a partnership with Microsoft to build an advanced financial AI platform to improve the productivity for sales and also personalized client experience. Now, as we know, there is a question with the majority of fund manager using the same providers to produce investment decisions. How are you comfortable, and how are you going to generate alpha? But also the question I asked about mitigation of hallucination risk. Daniel's already talking about, now machine learning is less of a black box because it's more predictive and you have a formula and algo. But then with generative AI, you are actually even black box. And so how comfortable are you without any human in the loop and providing that investment advice to your clients?
There's a lot in that. So let me first just talk about the Microsoft partnership. So we approached Microsoft with a very simple problem that has a very difficult technical solution. And they were excited about, because most people are approaching AI with a simple proof of concept on, let me reconcile, we do it too, let me reconcile this data, let me generate this RFP. This is more of a platform. And so the simple problem is, how do you optimize the conversation, say, a salesperson has when they go visit a financial advisor? And so you need the AI to go in and look through your CRM system to get whatever information you have there. You're going to want to understand the holdings. You're needing to go to external third-party data to compare kind of performance. You're going to want to look at your own performance data that's going to be able to figure out which is the most optimal opportunity to pitch to the advisor. You're going to go look at social media, and you're going to figure out, what kind of personal connections can I make. Each of those things requires a different AI algorithm. That's the technical problem, right? So it's that integration. And, I always say large language models are like the kid who gets an A in English and an F in math. You have to marry them and integrate them with very specific algorithms that can calculate things. And each of those end up being very specific. And the skill set of the programmer to build those models is different. And so Microsoft actually liked the idea behind it and are supplying us with quite a few resources to build it because they want to get the domain knowledge to understand how they can ultimately go to other firms and say, hey, we can help you do this, right? We're doing the same thing on the investment side, and it will be Microsoft or somebody else, where from an investment person, think about, you have an idea and you want to, let's say you were covering transportation, that was your sector, and you're wondering what, the global positioning system technology might disrupt, right? Think about how much it did ultimately disrupt with Uber and other types of car servicing or shared car services. So you'd ask the question with kind of a ChatGPT interface. It would go through all your analyst reports. It's going to go through the street reports. It's going to look through what kind of people have been talking about it, just massively evaluating information, bringing it back, and then the key is, and that's dealing with hallucinations, is you have to have a human who's evaluating it and able to prompt the right questions, right? And so that's where the skill set and having kind of the curiosity is going to be really important in employees to be able to iterate, and that's where you ultimately get your alpha, right? It's just about being able to consume a whole bunch more information in a way that you can consume it quickly, and ultimately still the human is making an investment decision.
So there will be a human going through this before you hand over
At
the
Franklin
information.
Templeton, there will be.
Yes, all right. So Mike, you're one of the largest active manager, and is known for your research and fundamental research and analysis. So how are you going to marry this AI thing with your portfolio team and in the research team?
It's interesting. If you dial back 25 years ago and you think about .com, make up a fake company, a cement company called World Cement Company. If they would have changed their name in 1999 to cement.com, the stock would have gone up $50. And so when our folks are looking at AI, you have to be really careful in not indexing AI, because that's really hard to do and it's dangerous. So any company you own that changes their name to something AI, you should sell it. The other thing I would say is you think about it in different levels. The participants in AI, everyone's seen that 4 stack or the 4 rungs on the ladder. And if you think of semiconductors and infrastructure and models and applications, one thing you'll notice on the 2nd, 3rd, and 4th rung of that ladder is there's some companies in common. Microsoft, Amazon, and Google or Alphabet are all in common in the 2nd, 3rd, and 4th rungs of that ladder. So I think that's something to be mindful of. You also look at the other impacts. People are talking about AI, but they're not talking a lot about AI robotics. Waymo from Google is basically a 4-wheeled robot. It's self-driving in 4 cities. They're doing 150,000 pay rides a week. They'll be at annualizing at 8 million, and they're just scratching the surface. Who in this room doesn't think in our lifetime you won't see self-driving cars gain a big market share in the marketplace? I think we all know it's coming. If self-driving cars were 10% of the miles traveled in the world, that would be a $150 billion profit pool. Our analyst looks at something like Google and sees Waymo not even impacted in the price in Google today. And you think about that kind of optionality over the long term. And Amazon with Sparrow picking 100 million items in 7 seconds with a low fail rate, drone delivery, these are all super exciting. The last part I would say is utilities. I was in New York last week and I saw our credit analyst who looks at utilities, and he said, I never thought I'd be a tech analyst. And I never thought I'd be in the growth sector. And utilities, you have to do both right now. And it changes a lot of things. So, John was talking about data centers. Regardless of anybody's math, everyone's pretty darn sure data centers will be more than double its current share of energy consumption in the US in the next few years. So these are going to be really important. What do data centers need? Cooling. Who's doing the cooling? It needs 1 million tons of copper. That changes your commodity outlook. So all of these things are really important when you're trying to do bottoms-up research and figure out who are going to be the winners and losers.
All right, so let's move to digitalization, digital assets and technology. Now, BCG estimates that the market size of tokenized assets could reach 16 trillion US dollar by 2030. That's the equivalent of 10% of global GDP. So Jenny, you said you spent 30% of your time looking at disruptive technology, and tokenization, you mentioned, will be the most disruptive trend in asset management over the next decade, leading to all mutual funds, ETFs, I don't know whether I'm misquoting you, being on the blockchain eventually. So what is Templeton doing in terms of positioning yourself and the insights you gain from the various really frontier pilots that you've been doing in Europe and also in Hong Kong with HKMA's Assemble box?
I believe I said AI and blockchain will be the two most disruptive technologies. Look, we started getting involved in blockchain, just starting to build things within the network around, I don't know, 2017, 2018. And then we had an approved tokenized money market fund in the US in 2020. I believe we're the only one running the actual money market fund, shareholder record, and transactions on the public blockchain. The other ones are shadowing the transactions on the public blockchain, and I'll tell you why that's an important distinction in a second. And then we started almost falling into it, but being what's called a node validator, where we validate transactions as part of the public blockchain on, I think, 13 different layer 1 or layer 2 platforms. And what we realized when we did that is, if you're going to be in this space, you have to actually participate in the network to be able to have the information to kind of make some of the decisions around there. So why am I excited, and why do I say that I think it disrupts, ultimately, mutual funds and ETFs? I have to tell you, Franklin Templeton ran 4 shareholder record-keeping systems globally up until recently when we outsourced it to, I think, this guy. Nobody ever asked what programming language any one of those systems were in until it was written in blockchain. And the most important thing is just remember, this is just a really efficient technology, and each different chain optimizes for different things. But we were astonished when we got the money market fund approved and we parallel processed between our old system and the new blockchain system with how inexpensive it was versus the old system. And so that one, from a cost standpoint, I think is really important. The second thing that's going to be important, and this is why the distinction of managing the tokens truly on the public chain in a wallet, is because if, for example, today we work in Project Ensemble with HKMA on a tokenized kind of stable coin, but ours will be a yield coin. If people are trading on the weekend and your transactions are part of a money market fund and they're just shadowed, they can't transact until Monday, right? And so if I need to transfer my token to Mike for collateral, it can't really happen truly until Monday. But if it's an actual tokenized unit, the settlement, everything goes with that. And then because it's a smart contract, you can have the NAV that's calculated immediately. You can have the KYC done as part of the token. All the things that we do can ultimately, now some of this is a bit out there, but ultimately can be embedded in that token, which is going to drive out a bunch of costs and friction in transactions, which is going to open up new types of investment opportunities. So that's why we're excited about it.
But you will need scale. You will need, if you want transfer across different banks, you will need an interoperable blockchain. So what are you doing? Do you see that scale?
Need scale in what way? What do you mean by that?
Well, if you are selling all your prediction, all your ETF and mutual funds will be on blockchain.
So exactly. So we just got UCITS approval. You really need to have global regulatory approval. Our view is all of this gets regulated, right? It all gets regulated. And it's difficult because, as you know, nobody knows better than you how challenging it can be because of things like atomic settlement and others, exactly how you define regulation in an environment that is changing so quickly. You know, if a value of a token in Fortnite can be sold between two people, should that be regulated in a online gaming? So it's complicated to do. But what we found is that you really need to be able to transfer these tokens across a global regulatory environment. And so, yes, from a scale, from that standpoint, absolutely.
Yes. Pong, you're a chair of EDX, which is a platform for trading crypto. So where do you see that platform going? I mean, now that Trump 2.0, so will we see more of activities there or regulation there?
Yeah, so, you know, it started a little over 2 years ago in many of our conversations with our partners and clients and counterparties, where there was an emerging desire among our US-based partners to look for a more grown-up way of transacting in crypto, right? So the issues ranged from people were uncomfortable with the lack of separation between exchange dealer and custodian solutions. People wanted a more familiar setup for exchanges with co-location, standard protocols. People were looking for central clearing solutions and so on and so forth. So, you know, we got together with our partners at Fidelity, Charles Schwab, Sequoia, and Virtu Financial, and started putting together a bit of a consortium and started a crypto exchange that's supported and underpinned by what you call traditional financial institutions based in the United States. I think the plan initially had a heavy institutional focus. Then the regulations over the last 2 years, instead of providing additional clarity, in fact, muddied what is okay and not okay in cryptocurrency for US-based institutions quite a bit, right? So by and large, SEC led a enforcement-based approach for crypto regulation, which made it more and more confusing. Now, but over those 2 years, instead, EDX have really focused on connecting to and trading with US-based retail platforms instead. So on the basis of that, EDX has grown a lot. Q3, in fact, grew by another 60%. That's a combination of increased adoption from the various different retail platforms, as well as increased interest and transaction volume in cryptocurrencies in the United States itself. Post the most recent election, I think the industry consensus view is that we will likely find more collaborative regulatory approach for the transaction of cryptocurrencies in the United States. And in fact, we're already getting some incomings from financial institutions that essentially went away over the last 2 years to start re-engaging in exploring how they themselves or they can enable the best way they can enable their clients to invest and participate in trading of cryptocurrency as well. So we continue to invest in that, support that, and it does look like we're at this pivot point where US institutions are taking another serious look at the investing and trading in cryptocurrencies.
Daniel, it seems that the banks are taking a slower pace, maybe because of regulatory constraints, but you do have a successful platform for trading intrabank Ripple.
Yes, if you could ask me several years ago how much this will progress, I would have thought a lot more than it did. And I think that one of the reasons why it didn't, is all the problems that happen with unregulated crypto changes, currencies, cryptocurrencies that came and go, created a very defensive approach from regulators. So therefore, the banks, at least in the US, we haven't been allowed to participate in public networks. We're only allowed in private networks. That makes the use cases a lot more limited. Yeah, we have experimented a lot in like intraday repos. We have a network of banks and the Monetary Authority of Singapore to process payments 24/7. We have done monetization and provide liquidity on tokenized money markets fund, but still very, very little. I think that this technology is so powerful that once it gets delinked to the good and bad of cryptocurrencies, it will probably evolve very, very fast. And I see, for example, in cross-border payments, a massive use case. In tokenized securities, a massive use case. So I think that this will accelerate over time, but at the moment it's been not as powerful as we would have hoped several years ago.
Mike, this time you have the last word. Remember last year you did not. So are we overestimating the change? Are we too excited about AI and digitalization in the next 2 years and actually underestimating that change that we'll make in 10 years' time?
Yeah, if you look at Netflix, it took 10 years to have 100 million users. It took OpenAI 2 months to have 100 million users. And now it has 200 million users. So we're in the noisy phase of implementation where there's just pride in the volume of activity in many people and less efficacy, but more pride. I think as you go through the cycle, it's going to be massively impactful to our world, AI in general. I think it will change jobs, it will eliminate jobs, it will create jobs, but it will be a huge impact for sure.
So thank you. Let's put our hands together for our distinguished panelists.
Thank you very much, Julia, and our panelists. Please stay on stage for a quick photo. Please stay for another photo to the right, our media friends. Thank you. Thank you very much. You may now return to your seats. Asian economies have been at the forefront of global growth, driving innovation, trade, and investment. A growing middle class, increasing urbanization, and a focus on sustainable development are opening up new opportunities in Asia. Let us hear what our panelists think about the Asia outlook and opportunities in our next panel. Let us welcome our moderator, Bonnie Chan, from the Hong Kong Stock Exchange, and panelists, Georges Elhedery from Ge Haijiao from the Bank of China, Professor Huang Yiping from Peking University, and Bill Winters from Standard Chartered. This session will be partially conducted in Putonghua. Thank you, Bonnie. Over to you.
So it's past noon, so good afternoon, everyone. I hope you've been having a great summit so far. It's wonderful to see a lot of familiar faces from around the world here in Hong Kong. And because Hong Kong is at the heart of Asia, this next topic discussion is going to be about the outlook and opportunities for investing in Asia. Now, just to set things in context, let me canter through some facts. So Asia is, of course, as we know, the fastest growing region in the world. It has 60% of the world population, contributes nearly half of global GDP, and 60% of GDP growth. It has 3 of the 5 largest economies in the world, 5 of the 10 largest stock markets, including, of course, Hong Kong, and represents 1/3 of the global bond market. Now, at the same time, new growth drivers are emerging. The digital economy, we heard from the last panel, a growing middle class, advancement up the value chain, and of course, amidst all these opportunities, there are also challenges that complicates business and investment decisions, such as domestic economic fluctuations, geopolitical tensions, regulatory complexities. But no fear, because we have 4 heavyweights, experts on the region's investment landscape to provide insights into the opportunities and the complexities. So without further delay, let's dive right into it. And we're going to start with George, because you are the newest kid on the block, shall we say? So let me turn to you for the first question. Asia has long been a strategic priority for your bank, HSBC. What's your current perspective on the Asian market, and where do you see risk and opportunities?
Thank you very much, Bonnie, and thank you, everyone. So we start with the heart of Asia, and from Hong Kong, and let's talk a little bit about China first. Again, at the heart of Asia, China 40 years ago, GDP was $250 per capita. It's $12,500 per capita today. In 40 years, the GDP is multiplied by 50 times. If you look at what China's achieved over that journey, over the last now 10 to 15 years, China's been the largest manufacturing hub in the world. China's been the largest exporter for more than a decade in the world. And China wealth has grown one of the fastest in the world. And if you look at Hong Kong, where we are here, Hong Kong's capturing more than 20% of the share of wealth creation movement offshore. And by leading consulting house, notwithstanding we're the Hong Kong bank, so I'll be talking my book here, but by one of the largest consulting houses, Hong Kong will be the largest offshore center by 2028, with about $3.2 trillion of managed funds for wealth, ahead of Switzerland with about 3.1 billion. So that tells you the journey that China's gone into and the outlook that it can provide. Now, starting 2017, tariffs have started to weigh on some of the economies, specifically on China. Then COVID, and then we went into a world frenzy of supply chain diversification, supply chain resilience, reshoring, and granted some re-onshoring has taken place. But the reality, really, what has taken hold is the China plus one strategy by many of the global producers, supply chain, global corporates. The China plus one strategy meant we wanted to find alternatives to create resilience and to create de-risking of the supply chains with heavy dependence on China. Well, it turns out that the plus one has, in most of the cases, been here in Asia. The plus one has been the Vietnams, the Indonesias, the Thailand, the Malaysias, the Singapore, the Indias. The plus one, granted, has been Mexico, but my Mexican colleagues remind me they're part of Asia Pacific. So there is a lot of benefit that this region has captured from the plus one. Now, more interestingly, a lot of the plus one has been a China-driven plus one. So China's been asked and tasked to build the plus one. So when you look at the FDIs from China into ASEAN, we're now at about 50%, displacing inbound investment into, or FDIs into ASEAN from the US, from Korea, from Japan. China's become the largest. If you look at trade patterns, ASEAN has become the largest trading partner for China, ahead of Europe and ahead of the United States, with about 14% of the Chinese exports. But also, interestingly, about 30% of ASEAN exports is back into China. So there is a material benefit or material virtuous circle that's been created in Asia with this plus one, China plus one opportunity. If you look at trade patterns and trade flows between now and 2020 and 2030, we're talking about 5 years actually, we're expecting those flows, intra-Asia flows, to increase by another 65%. Now, this is massive considering they're already larger than many of the flows going across the Pacific. So it does give us a sense of the value of the opportunity here. I mean, we at HSBC, we have 60% of our 210,000 staff based in Asia. We have about 30,000 people here in Hong Kong, 30,000 people in mainland China, 45,000 people in India, 20 people in ASEAN, 20,000 people in ASEAN, another 10,000 people in the Middle East, if we look at this as the extension. But if I turn to the challenges, there are many challenges the region is facing. There are many challenges that China's been facing, which we talked about, I'm not going to dwell on, but structurally the strength is there. Cyclically, the challenges have to be overcome. There are also challenges that we haven't talked about, and I'll call one out. This is a highly dollar-dependent region and a high dollar rate dependent region. In other words, high dollar rates for economies with floating currencies is putting pressure on the currency. And the moment you put pressure on the currency, you put pressure on foreign direct investment and other financial investment. And then for those currencies that are either pegged or managed, high dollar rates means high funding cost and basically a break somewhat on the economy. And that's really particularly the case of Hong Kong dollar, that's faced with a very high rate environment due to the peg, but with a slower economic backdrop, and that obviously exacerbates the cyclical pattern that we're facing. Thank you.
Well, thank you for that. I do like the fact that we're starting the discussion about outlook and opportunities in Asia by talking about China first. But as we know, Asia is a very diverse region with developed high-income economies alongside a lot of emerging players in the ASEAN. So let me turn to Bill. As one of the largest international banks in Southeast Asia, what opportunities do you see in the region? And would you say that ASEAN is now a key driver of the overall Asian growth narrative?
Yeah, thanks, Mani, and of course, thanks, Eddie, and everybody for having us. I completely subscribe to George's views about the importance of ASEAN in its own right, but then vis-a-vis China. So, not to repeat what George has said, but the China plus one is largely going into ASEAN, and the trade flows are increasingly important. So, as one of the few largest trade banks in the world, our largest trade corridor is China-ASEAN, and it will continue to grow quite quickly. The opportunities from here, I think, are the greater unification of ASEAN itself. ASEAN, it is a trade pact, but it's nothing like a free trade zone. So the intra-ASEAN flows, either through Singapore or between these countries, are still a fraction of what they could be if ASEAN were to continue its process of political reform and unification. But Bonnie, as you say, it's quite a diverse region as well, with some of the wealthiest countries in the world, and as well as some lower middle income countries and growing. So I think the opportunities in ASEAN are huge. The region as a whole has tremendous access to some of the future minerals that will be critical. We're seeing in Indonesia. A big chunk of the EV supply chain is coming out of Indonesia today, and Indonesia, I think, has been quite clever about the way that they've effectively forced a vertical integration into Indonesia. So it starts with mining nickel and lithium, and soon you're producing batteries, and soon you're producing the electronics that support the battery production. This has been a real driver of economic growth in the region, and I think each country in ASEAN has that angle, or at least certainly the ones who have been most active, thinking Vietnam and Malaysia. And then there's Singapore, which I know that Singapore and Hong Kong love to pretend not to compete with each other. And all I know is competition is good because it makes everybody better. We're completely agnostic, I can tell you. I'll say the same thing in Singapore on Friday. We're completely agnostic about this competition. We want Hong Kong and Singapore to thrive. And I must say, and I know George is in the same position, but having a big presence in Hong Kong and Singapore, actually the amount of cooperation between these countries in terms of the core values of promoting trade, investment in Asia, being say, responsible participants in the global economy and in global markets, setting wise regulation. There's more in common than there is different between Singapore and Hong Kong. And that, of course, makes me very happy because we don't ever have to criticize anybody. We can just praise all. But at the moment, we're here in Hong Kong, and man, is this place buzzing, right? I mean, for those of us that have been here for 3 years, to have come the first year as we were coming out of COVID, the second year to say, yeah, China and Hong Kong are relaunching, to come this year and feel a real buzz in the environment. That, of course, is reflected in all of our businesses, I think, which are doing quite well. And I wish many years to come. So thanks again, Eddie, for having us.
Well, thank you for that, Bill. And, I like your remark about, praising all. And in fact, a few weeks ago in Riyadh, we had this debate about whether the world is deglobalizing or reglobalizing, right? I'm going to go off script here. Do you think we have a chance of, doing more reglobalization if Asia worked together more?
Absolutely. I mean, there's two trading unions in the world right now that are way underdeveloped. ASEAN is one, and of course that connects directly through to China, and Hong Kong is a central participant in that. The second is in Africa, not the topic today, but there's an Africa free trade zone. It's just getting started. That connection, that trade corridor between Africa and the Middle East, between Africa, South Asia, between Africa and Asia, is big and growing very fast. So to the extent that we can get the internal cohesion in these trading blocks so that the logistics make sense, that you can actually transport something from Nigeria to China via Kenya and all the countries in between without paying tariffs and logistic charges, et cetera. Now, we're a long way away, but the commitment, the political commitment is there. And of course, when you've got a buyer at the end, which in that particular example is somebody in China, they're going to do their bit to make sure that that unification happens because it's in their interest to have a sustainable supply chain where with data that's cohesive, with a tax regime that's conducive. So yeah, I mean, all this globalization is dead, globalization is going backwards. Sorry, it's just simply rubbish. It's just not true. Globalization is as strong as it's ever been. It's just showing up in different places. Trade volumes are increasing. 60% tariffs coming out of some country to another country will not change the aggregate level of global trade. It will just redirect the flows. Of course there's a friction cost, and we're all going to pay for it. Of course there's a friction cost. But man, markets are so cool. They immediately re-equilibrate around the friction cost so that economies continue to thrive. So yeah, bumps in the road for sure. Globalization ain't dead and it's not going to die.
All right, we'll leave globalization as a separate topic, and you do it in another day. We can talk for hours on that. But thank you for teeing me up for the next question, because as you said, it goes back all to China. So I'll turn to Professor Huang. So this morning we've heard from the leaders. Mainland authorities have announced a series of monetary and fiscal measures. And so far, I think the jury is still out because it's drawn very diverse opinions from market analysts. So how do you think these measures should be understood and assessed? And what would be the broader impact on global investors? Would the potential changes in US trade policies have any bearing on China and Asia? That's a very frequently asked question in the last few weeks.
Well, I don't think there is any disagreement on whether or not the macro policy actually turned. The question is, I think, whether this is enough. The market is always disappointed by the fact that the number is not big enough. I actually think that's a psychological game. My own advice, obviously, is that the government should announce a huge number, because if investor expectation changes, then you don't need to spend all the money. So I think that is still the reason why we're still debating whether that's enough or not. But my own take is that I think whether or not that number is enough is one thing. The policymakers have made it very clear that if this is not enough, more is coming. In fact, the Governor Pan Gongsheng said on the 24th of September, more on the pipeline. The finance minister said something many people didn't notice, but he said the central government has ample room or potential to raise further debt and to increase the deficit. These words you never heard from MUFG minister during the past years. They always say we needed to be prudent, we needed to reserve room for further future action if it's required. But this is time, I think they made it very clear. So my sense is I'm pretty convinced that the policies are aggressive enough to turn around the macro economy. There might be some other issues still around, whether, for instance, what the local governments do would be supportive of the policy expansion. And sometimes I actually am thinking they are actually doing the opposite, because the local governments are fiscally constrained at the moment, and some of them cutting the salaries for their own employees, and they're also trying to create some new revenues, which is not very positive for entrepreneurial confidence. So these are the things I think we need to fix. But I'm not worried that the policies have already turned. Now, the Vice Premier and the 3 ministers also mentioned the term incremental policy. I had some conversations with investors during the past weeks, and some said to me they were a bit worried because the government was saying incremental policy. That means probably piecemeal, gradual. In Chinese, 增量, incremental actually means additional measures. That means more measures coming. It's not like a very piecemeal or gradual measure. So just want to clarify, this is obviously my interpretation. But whenever they say incremental policies, it really means on top of whatever they have done, they are determined to do more to turn around the economy.
Right, so maybe the translation should not be incremental, it's accretive. I think that's what it meant. Anyways.
I'll make the recommendation.
Earlier, George talked about the +1 strategy, the go global. So I'd like to now turn to Chairman Ge to elaborate a little bit more. And the next little bit is going to be in Mandarin. So I'll give a few seconds for people to put on the headset. 各董事长，那近年来国际环境变化是不断的啊，那区域经济金融合作也正在经历很大的一个调整。中国银行呢，作为一个内地的龙头大行，你对内地企业客户今年走出去啊，我们所说的 +1 啊，这个投资的趋势变化有什么的一个观察？ 你认为呢？这个趋势会对国际金融机构带来一些什么的机遇和启示呢？
谢谢主持人，我觉得是非常好的一个问题。内地企业走出去呢，其实呢，我也在想思考这个问题呢。过去10年呢，发生了很大的变化。我们回到2014年，我们是招商引资。 内地呢，我们更多的是寻求呢外商直接投资。2014年出现了一个变化，外商直接投资的增量首次呢跟对外直接投资的增量发生了一个变化，就是对外直接投资大于了外商直接投资。到2016年，又发生一个新的变化，就是这2个数据的存量。 对外直接投资和外商直接投资 （ODI） 和 FDI 的存量达到了一致。最新的数据，去年的数据呢，在全球 FDI 呢下降的情况下，下降了超过2%的情况下，中国的对外直接投资增长了超过8.7%。这是一个我们从趋势上来看的时候是一个巨大的变化。同时呢，中国的对外直接投资呢。 更多的是体现在呢，对亚洲，过去5年呢，对亚洲的对外直接投资的占比超过了70%，说明呢，中国内地企业对亚洲市场是充满持续的信心。同时呢，在这个过程之中呢，非常显著的是，更多的对外直接投资的增量呢，是投向了“一带一路”、东盟，包括非洲。去年这个增量呢。 都是非常巨大的一个对外直接投资的增量，同时在企业方面也更多的显示出呢，我们更多的是在多元的领域，其实覆盖到了制造业、批发零售业、金融业、商业、租赁服务业，这些都是非常显著的增长。在这个过程中呢，中国内地企业对外投资的时候呢，也更多的关注呢可持续发展和绿色问题。 更多的中国的企业在内地企业在对外直接投资的时候，是把融入当地社区 更多的呢是作为一个最重要的考量，不仅仅是经济效益，更多的是呢融入当地核心的考量。其实对我们的金融机构来讲，不管是中国内地的金融机构、国际的金融机构来讲呢，带来了很多新的机会。我觉得简单的说，可能第一个最大的机会就是，更多的对外直接投资的企业需要一个更多元的结算货币的选择，就是人民币如何在对外直接投资和国际贸易投资中呢能够发挥作用。我觉得给金融机构呢，国际金融机构、中国内地金融机构呢，在产品服务上提供了更多的新的需求。第二个呢，我觉得这个过程中呢，就是香港可以发挥更大的作用。依旧呢，香港这个平台的作用呢，帮助内地企业对外投资的时候呢，我觉得从税务、法律，不仅仅是金融、运营能力、人才优势，还是可以继续发挥作用。第三个呢，对于金融机构来讲呢，就是特别是国际金融机构呢，对于绿色发展的理念呢，具有足够的经验，内地企业可以呢跟金融机构之间呢有更深入的互动。我觉得。
好的，那个或者追问一题啊，因为我们都知道那个金融是服务实体经济的，那你刚才也说了，那个在这个出海啊，这个 +1 当中，那有很多的领域，包括是一个绿色的转型啊等等，都是重点发展的一些方向。那么我们早上也听到领导们他们说要推动内地的高质量发展。那么我希望可以再听一听各董事长，你对这一些高质量发展方面到底你认为重点的那个行业，除了刚才说的绿色转型以外，还有什么我们应该关注的？而且呢，更重要的是，内地的银行业，你们做出了一些什么行动来支持配合内地的经济发展而且这个又带来给国际的投资者一些什么机遇和风险？
内地的高质量发展和银行业之间的关系呢，在过去30年、过去20年、过去10年都发生了显著的变化。除了刚才讲到的这些呢，刚才杨教授也讲到了内地的增量政策带来的推动高质量发展。过去10年呢，特别是过去5年呢，推动经济高质量发展的过程中，银行业的金融服务，尤其是内地银行业，其实呢，在支持科技创新方面是起了巨大的作用，在支持呢普惠小微企业发展方面起了巨大的作用。到今年前9个月的各种数据表明呢，在这些方面的金融支持，在经济呢在一个相对低的一个增长的情况下，金融机构对这些行业的支持呢，还是都有超过10%以上的增长，这个是非常显著的。我们从金融的从业者的角度看的时候呢，我们在这个方面的投入，是在过去相当长一段时间里呢，是一个持续保持高增长的态势。这也促成了中国的科技创新，特别是绿色低碳的发展能够取得现在的一个成果，金融支持是密不可分的。另外一个方面，在整体上这个过程中呢，尤其是今年的我们所谓的增量政策推出之后呢，我们能看到呢，内地市场的信心、国际市场的信心也在发生变化。11月份以来，大家看到呢，沪深两地的股市日均交易量呢都在2万亿以上的一个高位运行，这个信心是在恢复之中。债券的发行规模前9个月也超过了60万亿，接近这样一个体量，增长超过了13%。同时，信贷规模也在达到了超过接近260万亿的一个增量的规模，在这个过程中呢，也达到了8%的一个增长。整体上，这个信心的变化带来呢，比如说最新的，国债收益率也已经呢，最新的10年期财政部的国债已经降到了2.01这样的一个水平，比6月份还是一个显著的下降的水平。其实市场的信心呢，我觉得在发生变化和恢复，给国际投资者和国际金融机构呢，我觉得还是带来更大的一个利润的空间和增长的空间，潜力依旧是在科技创新和绿色转型方面。
所以高质量发展，English translation of that is high quality development, I think. Maybe we'll stick on the theme of these terms, which sometimes is quite difficult to appreciate once it's translated. So with the new, the high quality development, there is also another term that we hear frequently, which is 新质生产力, right? The new quality productive forces. So maybe I should ask Professor Huang to help us understand that better. Now, China's growth rate obviously has seen a significant adjustment, right, from about an average of 7% between 2011 and 2019 to now about 5% in the post-COVID era. It's still an impressive figure, of course, considering that it's the second largest economy in the world. However, what is going to sustain this growth, we heard, is going to be a shift in the economic model and focusing on this quality growth, this 新质生产力, right, the new quality productive forces. Professor Huang, perhaps you can help the audience understand how this transition is progressing and how we should actually look at the opportunities embedded in it.
Well, I think you probably heard the term the middle income trap before, which is not a scientific term, but it basically says many countries can rise from low income to middle income. But most countries would not be able to rise to high income. That's World Bank data shows. For China, I think what we're facing at the moment, our school actually did a joint research with the Brookings Institution, look at the growth outlook for the next 30 years. The key finding was economic condition is already changing. Regardless of the past success, we are entering into a new phase of development, and I can at least summarize 3 key changes. Number 1, the low-cost advantage is gone now. Income level is much higher. Number 2, the population dividend is replaced by rapid aging of the population. And number 3, well, we're still very positive about the globalization, I heard from Bill, which is true to some extent, but the external environment becomes much, much less open and friendly for us. So the question is, how do you continue your growth in this new environment? And I think this is the background of what Bonnie just mentioned, whether you call it high quality development or new productive force productivity and so on. Bottom line is, for us economists, bottom line is you need to raise your total factor productivity. You need to remain competitive in this new environment. So I think this is why we're all looking at the new sectors we're pushing. The key question I think it boils down to is, well, can China innovate? When the cost is becoming higher, when the external environment is less friendly, when labor supply could actually be declining over time. The impression, I think, by Westerners on China's national creative capability is very extreme. I give you an example. In September last year, the US Commerce Secretary Ronald came to Beijing, and she invited Professor Yuen and myself to lunch with her, a small lunch. Her first question was, what is happening in the Chinese economy? Because all the opinion pieces she read in the Western media appeared to suggest that Chinese economy was about to collapse. And then in April this year, we received Janet Yellen, the US Treasury Secretary at our school. Her first point was, your overcapacity in the EVs and other green energy sector is going to eat our lunch. So I guess this is what I'm telling you. Some people say China has no innovative capacity at all. And others say, well, at another time, they say, well, China is going to take all their opportunities of new products. I think the reality is probably somewhere in between. China can innovate, but most of it is still in applied field. Even when we talked about the AI, China is rapidly catching up, but most of them is in application, not original research. So for instance, look at the EVs. The US complaint is about the state subsidy. But if you look at the state subsidy, we have scholars looking at the actual subsidy per unit of EV. China was somewhere in the middle. The highest was Norway, the second was the US, followed by Germany, France, UK, and so on. So state subsidy was an issue, but it's not the key reason why the EV industry expanded very dramatically. I think the local government probably helped in expanding the capacity, but that's another issue. So I think the question now is, can China innovate? My sense is we can. But the problem or the question is, I think we should push to innovate in a large number of industries, not just in 3 areas. So policies still have room to improve. If you look at, for instance, Michael Porter, a professor from Harvard Business School, he looked at the so-called innovative capacity, and he has a long list of the factors which are very important. These are the factors I think we should look at in China. And the 2 most important factors at the moment, number 1 is we need to keep the country open, because you can't imagine that you can do all innovation by closing the door despite all these geopolitical tensions. Number 2, the dynamism of the private sector, which is vital.
Thank you for that. You know, we do need more different manifestation of the new productive forces. And, you know, I really want to carry on this conversation, but unfortunately, the countdown clock is in negative territory right now. So we do have to end this very fascinating, insightful conversation. My thanks to George, Chairman Ge, Professor Huang, and Bill for the very insightful discussion. And I hope we can do this very soon again. And of course, thank you everyone for joining us. I hope you've enjoyed the conversation. Thank you.
Thank you very much, Bonnie, and our panelists. Please remain on stage for a quick photo. Thank you. And to our right, please. Just one more to our right, please. The photo over there. Yeah, thank you. Yeah. Thank you very much. You may now return to your seat. We've now reached the final panel before lunch. The past 2 years have presented significant challenges for private market investors, with slower fundraising, higher interest rates, and a macroeconomic outlook clouded by geopolitical tensions. Despite these challenges, private investors' demand for private assets remain resilient. On our next panel, our speakers will share their thoughts on private market capital deployment in the current environment and where they think present the most compelling risk-return opportunities. So now let's welcome our moderator, Neo Shen from Hongshan, and our panelists, Zhou Bei from KKR, Jim Coulter from TPG, Rob Lucas from CVC, Howard Marks from Oaktree, and Harvey Schwartz from Carlyle. Thank you. Neo, over to you.
Thank you. Thanks, HKMA, for inviting me, and it's my great honor to moderate this session. We got 5 heavyweights in the private markets. I guess private market has really played a very, very important role, as Mark was, alluding to in the early session, that oftentimes was feel it's more risky than the public market, but it turned out to be safer and creating better returns. So let's start from Howard. you have wrote letters all the time, and one thing you have mentioned about the sea change that you mentioned 2 years ago, highlight that a substantial portion of the investor return over the last 40 years because of lower interest rate environment. And the year ahead won't be that easy. So can you share a bit on that particular note, like given the rising asset price and the declining cost of capital, before for the private equity, and now, what are we going to expecting to see in the future?
Thank you, and thank you for giving me the opportunity to be here today and on this great panel. In the memo, I said that in 1980, I had a bank loan outstanding personally, and I got a slip of paper in the mail which said the rate on your loan is now 22.25. And in 40 years later, in 2020, I was able to borrow at 2.25. Now, I hope I became a better credit, but I think that was a very, very important factor in the history of the world. In fact, I think it was the most important single event in the financial world in the last half century. Now, it took a long time and it was gradual, so it might have gone unnoticed, but very important. And so that's number one. And of course, declining interest rates make, among other things, make assets more valuable and make the cost of borrowing less. So that leads to number two, which is that something we call the leveraged finance industry was invented in that period. And, private equity and, of course, the growth of real estate and other leveraged strategies. And, of course, the beneficial effects on the value of assets and the cost of carry were very helpful to those industries. And they got traction, and, of course, private equity, which my co-panelists are the leaders in, have been described as the silver bullet in the last 5 or 10 years for any pension fund which is underfunded. So that's very, very significant. And then, of course, in the 09 to 21 period, we had the lowest interest rates in history. The Fed funds rate was 0 most of the time and averaged 0.5%. And that was a great time. Now, that brings us up to date, almost. But in that period, when credit is readily available and almost free, what's the smart thing to do? Leverage up as much as possible. And a lot of people did. Now, of course, things have changed. We had a bout of inflation that required the Fed funds rate to be raised from 0 to 5.25, 5.5. And many investments were saddled with capital structures that didn't anticipate a 500 basis point increase in rates. And they'll have to go, some have adjusted, some more will have to go through a period of adjustment as we get maturities, et cetera. But I think the important thing is that when leverage is not as cheap and not as readily available, the ability to produce returns will come from being able to buy things well and add value, not from merely buying, levering, and enjoying an increase in multiples. So this is a lot of what our industry has to do ahead. In this period, I think what I would say is beta will not be enough, market trends. It'll take alpha, personal skill. I think that, look, I'm sure Mark is right, that, private credit has gone from about $250 billion in 2007 to about $1.5 trillion today. So 6x in 17 years is a hell of a growth rate. I'm sure it'll keep growing, but we all know that in that period it didn't really, the tide didn't go out, to paraphrase Buffett. We didn't find out who's naked, and one of these days we will. So that, I'm just trying to set the scene, and I look forward to hear what everybody has to say about this environment.
Great. So have to buy well and seeking alpha. Harvey, so you have a Washington roots, Carlyle. So how you look at interest rate environment? and how you look at it, the potential impact on that front with Trump 2.0.
Well, first of all, it's great to be here, Neil. Thank you, and congratulations to the HKMA on a fantastic event. It's an honor to be here. So before I get involved, I want everybody to know Howard and I are friends. And he just gave a very good description of economic history, and I wouldn't debate that with Howard. But what I would say is over that period from 1980 to today, the first part of that decline in interest rates, which he did highlight very explicitly to 2009, I think that that was really driven more by monetary policy, globalization, increases in technology, efficiencies in capital markets, and basically everything that drove deflation over that period. From 2009 to today, that excessive period of monetary policy was really in response to 2009. And of course, I think we'll look back on economic history and we'll see that it was really unfortunate that the financial crisis happened in 2009 and the pandemic followed pretty quickly after because it doubled down on fiscal spending and support, and it also doubled down on monetary policy. And then, of course, we had the reaction we had. I think that in any investing activity, one has to be in a position of micro asset investing. You have to have a value creation plan. And the way we think about private markets, we're $450 billion at Carlyle today. The largest segment, by the way, is credit and insurance because of the growth in that market. When we think about private markets and when you look at private markets, very little about the evolution of private markets has to do with the decline in interest rates. It has to do with the ecosystem of finance. We didn't have ETFs. You heard on the earlier panel, it used to cost, I don't know what Pong said, $100 to trade a share of stock or several shares of stock. This has been an advancement that's happened from the 90s. I don't think the Wilshire 5000, Howard, you probably know, has had 5,000 names in the Wilshire 5000 in a very long time. We've actually lost half the public companies. That's not because we made a rule that public companies shouldn't exist. Companies figured out that private capital would allow them to grow more efficiently. And so I think private capital has played that role. In terms of interest rates, and I think I'm the first person that's been asked explicitly about Trump, but this is what I'll say. With respect to interest rates, when we look at our portfolio companies, which cover more than 1 million people around the world, the economy generally looks good. It looks particularly good in the US. And the data supports everything you're seeing in the numbers. A year ago today, if I was here, I would have told you we thought based on the KPIs we roll up, we would have seen 2 or 3 interest rate cuts. I think now we actually don't see a number of interest rate cuts. Last year, the market was calling for 6 or 7. We may see a handful next year, depending on how things evolve. But all the policies we know Trump will put in place, lower taxes, more spending, less regulation, those are all pro-growth. And you're seeing it. So I would expect interest rates to stay higher. But the key point I think Howard raised is a market clearing cost of capital is better for everyone.
Great. So, Joe, with this new changing dynamics, right? And we all know that we just cannot rely on multiple expansion to creating return. So what are the playbook for private credit investors, specifically KKR? What are the strategy you're adopting to creating, the good return for the investors?
Well, first, let me thank you, HKMA, for this incredible event. It's great to be back here in Hong Kong. I think Howard said it well. This is about buying well, but more importantly, creating alpha operational value creation in the companies that you fundamentally buy. I think in our industry, it's a very competitive industry. If you look at this panel here, everyone's constantly trying to evolve and increase their competitive advantage in the marketplace. So how do we do that in private equity? First of all, it's around capabilities. So it's not just about having really smart deal teams. It's about industry specialization, fundamentally. It's about being focused on the right thematics to win long-term tailwinds. It's about creating other parts of your firm's specialized capabilities, government affairs, public policy, especially in a market like this where regulation, tariffs could be an incredible source of risk or opportunity. It's about having operational executives and specialists on your team. We have an in-house consulting firm called Capstone with over 100 executives working with our portfolio companies every single day. We have an in-house capital markets team. When you think there's going to be volatility in the financing markets or access to capital, we have a 100-person capital markets team. In the last 5 years, they've been underwriters or arrangers of over $850 billion of debt and equity transactions. 2/3 of that is for our own portfolio. 1/3 of that is for third-party clients of ours. So you need a lot of different tools to win in today's private equity world.
Great. So to Jim, so we already talked a bit about how the opportunities present themselves to the private equity investors, but given the evolving regulatory changes and potentially macroeconomic disruptions, what do you think about the sector itself, private equity as an industry? What are the structural changes that the industry could actually evolve into?
I'm a student of industries, and actually one of the most interesting industries I'm involved in is our own. So 40 years ago, a few of us got together in these small partnerships to launch something that didn't have a name. It wasn't named until 1997. Today, that is a $6 trillion industry. And the dollars really don't capture it. If you look, just to use US numbers for a moment, about 7% of the US employment base is in private equity. There's 4,800 public companies in the US. There's 30,000 companies, some of the most interesting companies in the private equity market. And the private equity market is the largest client for banks, law firms, consulting firms around the world, because it's an industry that remakes itself every 5 years. So interestingly enough, one of the most fascinating investments you could have made in the last 30 years is the private equity industry. But it hasn't been uninterrupted. There have been moments where things have gone to hell, and there was 89, 90, there was 2000, there was 2008, and in those moments, two things happened. The industry themselves changed the structure, and something good came out of it. Out of the 1990 disruption, the private real estate business came out. The software investing business came out of 2000. The private credit business came out of the global financial crisis. So good things happen, but also change happens. We are in one of those moments right now. Fundamental shifts happening. What am I seeing? First of all, the strong are getting stronger. I'm happy to say you can see it in our stock price, but for the first time, I think people are understanding this industry is hard. I went gray at 35. Like it's not hard to make investments, it's hard to make them over 30 years consistently, and places like HKMA need us to do it for 30 years consistently, and that takes a staying power. In this cycle, John, you know this, more dollars have gone to the top firms in this cycle. There's also going to be a shakeout. Bloomberg recently reported that 25% of private equity funds haven't raised money since 2015. It's hard to kill a private equity fund. They stick around for a long period of time, but the industry is remaking itself. And with capital tight in the institutional marketplace, private equity will find new sources. And what's happening is insurance is a form of savings going into private equity and private credit. We're now going to the high net worth channels. So the industry is fundamentally shifting in some funny ways. And there's going to be some problems to solve. The venture capital industry has a huge NAV problem right now. It's only returning 5% on NAV. It's usually 25%. Obviously, we've got to get DPI flowing in our industry. So fascinatingly enough, one of the most interesting sets of opportunities I see are very close to home. And keep an eye on the private equity industry. One thing that people tend to do wrong is this is when they step back from the industry. The industry was declared dead in '89. It was declared dead in 2000. I remember in 2009, my then 12-year-old daughter walked in and said, Daddy, are you okay? I had the Wall Street Journal in front of me, and the headline was, "Private equity is dead meat." That was 2008, before a huge growth in the industry. So this is a moment of time where there will be a change in the industry, but as Joe was saying, the tools of the industry mean that interesting times are also ahead.
Great. So private equity is definitely not dead. Actually, Rob, congratulations to you. We just saw the successful IPO of CVC. So how you look at, the sort of this listing considerations as a private equity manager, and how that listing going to be contribute to your long-term success?
Well, first of all, thank you very much to Eddie to Howard, and the HKMA team for inviting us all over. It's a privilege to be here. No, thank you. It's exciting times, and I think compared to all my colleagues on the stage here, we of course took a lot longer to take the plunge into the public markets, and so we certainly had plenty of time to give it consideration. I think the key for us was actually ensuring that in going public, we didn't lose the very ingredients that were the source of our success. And I would particularly point to two areas. Firstly, having the delivery of sustainable outperformance for our LPs as our key priority. I think that's always how we've built CVC, and making sure that that absolutely remains the preeminent element of our business is key. The second one actually is about culture, interestingly. Just before David was on earlier on, but I asked one of his very senior colleagues to join us at our offsite over in Athens earlier in the year to talk to us ahead of our IPO about what were the main things that Goldman had found were challenges about being public. And he actually said culture and communication. So I don't know whether my colleagues on the stage here would agree with that, but certainly maintaining our culture, because the culture is the glue that holds CVC together. Our business is based on a huge international network, 30 offices across 5 continents, and making sure that all of those people communicate, they work well, the relationships and the culture that binds everyone together remains. So those were the key considerations, Neil, that we had. In terms of how it is likely, and we hope it contributes to the ongoing success of CVC, well, it's exactly as Jim's just been mentioning. We're seeing huge changes within our marketplace, all of us. And we're seeing huge consolidation, actually. What we are seeing, as Jim's just said, is the strong getting stronger and the weak struggling. And certainly in terms of the largest and most sophisticated LPs, they are consolidating their relationships and their investment across our industry. They are looking to place much larger amounts of capital with fewer GPs, and they are looking at those GPs with whom they have the deepest, broadest, and longest relationships, and who have delivered for them for the longest period of time. And so that is a key theme. The other key theme, of course, is consolidation amongst the private markets players. And that's a very, very important part in terms of us all growing and broadening our strategies and our platforms. And so being public, I do really feel, gives us longevity. We're in a very, very long-term business. It's about structure and governance, but it gives us the strength of balance sheet and the strength of brand to allow us to build our business in terms of broadening that platform and participating in that consolidation. And of course, we are all ultimately people businesses, and it allows us to continue to attract and retain the very highest quality people. Those would be the key elements, I think.
Great. And European private equity has shown some very significant resilience. So in your view, what are the great opportunities that are out there for you? How you read the market, opportunity for European buyout?
Yeah, well, of course, Europe is our heartland, and Europe has, as you say, been remarkably resilient over a very, very extended period in terms of delivering private equity returns. In terms of the dynamics of the market, I think it's the ability in that resilience is very largely linked to the dynamics within the market. And those dynamics are very much about complexity. I mean, it was interesting hearing Jean talking earlier on about the challenges that Europe confronts. Europe is an ever-changing dynamic, and it's very, very hard to predict. And I think that is the essence of Europe. Different countries, different regions are facing different dynamics at any given time. And that is why it creates both complexity, but also it creates a lot of inefficiency in the market. I think certainly compared to the US, the private equity market in Europe is a lot less efficient. And of course, for those of us in strong positions within that market, particularly with local people on the ground in those markets, what that means is that we have an ability to really outperform. And that's the real key to the dynamics within Europe. Having local people on the ground in the local markets, and then also just in terms of looking at opportunities, it was interesting just hearing the discussion just now about what it takes to succeed. In Europe, I would add another element in terms of what it takes to succeed, in terms of in addition to just having local people on the ground in the local markets, it's about actually not trying to sit at the top of the organization and predict where and how the opportunities will arise. It's about being bottom up and actually being able to sit at the investment committee at the top and see where the really interesting aspects come through. And that's the key to the future, I'm sure, within Europe.
Thank you. So, today if we talk about private investment, one cannot just go without mentioning private credit. Indeed, this is a hot market, and this seems to be getting to a stage of golden age. And Howard, I just want to like you to share some thoughts on this. Where do you see the those attractive opportunities within that particular sector? At the same time, we have heard last year's panel, this year's early panel, all talk about some regulators have concern about this market grows so big that creating some instability from a regulatory perspective. So what do you think about that? Are you concerned?
Well, obviously, as I mentioned, private credit is a big deal now. It wasn't 20 years ago. And as I think Mark mentioned, a lot of its growth grew out of the failings of the banks or the shrinkage of the banks post-GFC. I think that, private credit will continue to grow. And by the way, every meeting I go into, people say, let's talk about private credit. And Mark, I always say, let's talk about credit. We're gonna have both, and maybe Mark's right, we're gonna converge. But I think the important thing to notice about private credit is that it is relatively new in its current size and iteration. And as Buffett would say, the tide hasn't gone out. And the tide will go out someday. And we'll find out who was swimming naked. And we'll find out who made good credit decisions or who did not allow enough margin of safety when they made credit decisions. There'll be some sorting out, as there always is. And then as Jim says, the best will get bigger. Let me just address for 1 minute, Neil, your question about regulation and risk. My own view is that we're not talking about systemic risks like we saw in the global financial crisis. In the global financial crisis, of course, which was underpinned by subprime mortgages, which had never been tested and which turned out to be entirely fallacious. Number one, we saw the disappearance as independent entities of Merrill Lynch, Bear Stearns, Lehman Brothers, AIG, and several others. I think for two main reasons. Number one, because they were hugely levered, which the private credit industry is not. And number two, because they were interconnected. And in 08, we coined the phrase counterparty risk, which then became a big deal. And, one person's assets was the next person's liabilities, and they could fall like dominoes, and appeared to be in the process of doing so until the process was arrested, I guess we'd say 16 years ago this month. But I don't see that degree of interconnectedness or the degree of leverage. And, you know, if some private credit loans turn out to have been mistakes and some pension funds or sovereign wealth funds lose a little money, I don't think anybody's going to hold the benefit or rush in with a rescue program. So I think that the risks are idiosyncratic, not systemic, and not alarming.
Great. Jim, back to you. So, you know, where do you see are those specific sectors that you're excited about? We got 2.6 trillion dry powders now raised over the last several years for private equity, venture capital. I know you're spending time and focusing on ESG, new energy. Tell us, like, what are the sectors that you like to get into?
We're about to prove that it's not about the landing. You know, one of the things that's interesting to me is we have an absolute fascination with landings. When you're flying home, the one time the plane is quiet is when you're about to set down, even though it's safer than when you pull out of your garage. Same thing is true in the financial markets. You know, a great party game is how long you can watch a financial show without someone saying hard landing, soft landing. Always take the under. And having traveled a lot, it's never about the landing the trip. It's where you start and where you end. And I worry that right now in the financial markets, we've had a 4-year debate. I think this is the longest one, Neil, I can ever think of hard landing, soft landing, hard landing, soft landing. But where are we landing? So I'm not a macroeconomics person, so where we're landing is a very different place. I was jet lagged in Mumbai the other day. I thought I woke up in '78. There were missiles in Gaza, there were tanks in Eastern Europe, there were politicians talking about price controls and tariffs. Like, this is a totally different world. We've assumed margins would go up forever, that markets would be global. We are in a different place, and have you packed for it? Eras are often defined by their business battles. We are going into some of the biggest business battles you've ever seen. Yes, AI is big, but who's going to win? This is battle of the titans. Someone is going to lose. Autos, like, you want to get a country upset, talk about their auto industry. We have EVs, we have ICE engines, we have hybrids, we have self-driving cars. We thought it was going to be about existing companies that were remaking the guts of their cars. We thought it might be about Tesla. It may be about battery companies that are just wrapping their batteries in cars, in cars, and those are now at 15% the price of an original Tesla. So what about it when EVs are cheap? Streaming, who's going to win that? Data centers, I agree with you, John, but the profit pools are very unclear. These are going to be fascinating. And what it will take to sort that out is not macroeconomics, it's actually investing skills. And what's on the table? Supply chains are 100% on the table today. For 40 years, we've been making them one way, just in time. Now, all of a sudden, as someone said, you know, just in case, we're bringing them back home. We're going to remake them in a few years. We're remaking our whole IT system on AI. We're remaking our whole energy system. We've done all these things before. We've never done them all at once. Huge capital is going to be needed. Huge investment skills are going to be needed. And then just to kind of give you an investor's perspective on the question you asked, you know, sustainability was an evangelical thing that was taken over by, you know, SASB and GFANS and SBTI, et cetera. It's now quietly become a practical thing. And if you cut through the noise to the signal, it's the cheapest form of energy in 85% of the world. Last year, it was $2 trillion of spending in CapEx. Fossil fuels were $1.5 billion. Yes, policy is going to change, but policy changes in healthcare all the time, and we all invest in that. Most of the policy debate appears to be on the Texas-Oklahoma border. India is not so worried about that. So around the world, this is kind of happening, and how we get behind it as investors is going to be critical. So this idea of, you know, you said it, it's going to be about alpha, but if I'm going to invest in something right now, I'm going to invest in investing skills, because this is an era where your alpha is going to come not from risk on, risk off, but which risk.
Great. So one area in the private investment we haven't touched is real estate. So Harvey, What's your take on the market? Because we have seen some significant repricing of the market over the last 2 years, and there are a lot of changing dynamics. There are headwinds on inflation, there's continued easing coming on the interest rate side, and then there's company asking or demanding their employees going back to office. So what's your take? Do you agree with John's comment early, about the sector?
Yeah, so the headline short answer, because it's always bad to stand the last panel between all of you and lunch, but the headline short answer on real estate is we like it. I think for a lot of people in the world that are not really embedded in the market, particularly in the United States, they think of real estate as, do you like office or not? Because that's what's gotten all the attention. And the real important point, which John talked about, is it's not homogeneous. So we've been in real estate for well over 20 years. We have an extraordinary team. They're actually actively raising capital now, so I can't speak a lot about that. But what I will say is this. When you actually begin to bifurcate the market into its component parts, when you look at office, we are not exactly particularly enthusiastic about office right now, broadly speaking. There are certainly very significant opportunities, but right now, if you look at for example, occupancy rates are running 5–6% above historical averages, even during some stress periods of time, and about $1 trillion to $1.5 trillion of real estate exposure, office space exposure, sits on bank balance sheets. That's not a healthcare Surgeon General's warning about that. That's well understood by the banking system, but it's a very slow-moving iceberg that has to be digested. And so when we think about that, sometimes we think, well, maybe the opportunities are more on the debt side of office, and certainly as it relates to people demanding people coming back to work, when you look at the levels of return, it's not as significant in the U.S. as it is in other parts of the world. And I think we have to assume at this stage, until we get different information, that the demographics of office space have just completely changed for an extended period of time. With respect to the rest of it, one of the things that's happened is interest rates went up, which maybe wasn't as well anticipated by all of us as we should, is the benefit to homeowners. So, for example, take my niece, who's a speech therapist on the East Coast. She locked in her mortgage at 2.7%. That asset, that financial asset for her, looks like a lot of financial assets for a lot of consumers in the United States. That is her best asset, other than when her uncle passes away, which hopefully that doesn't materialize anytime soon. So that's a valuable asset for her. But as rates went up, people were very reluctant to move. And of course, they don't have to move as much now because they can work from home. And so you haven't had the residential creation of housing. And so you do have the shortage that John talked about, multifamily, rental housing, and then demographics, which really are the key here in terms of the shortage of housing, construction because of rates being higher. So there's certainly segments we like, whether it's, warehousing, logistics. I think that's all a very bright spot. And with office, we're super selective.
Thank you. So Joe, back in 2005, you are employee #1 for KKR in Hong Kong or in Asia. Now the firm has expanded to 9 offices in the region. You have close to $70 billion under management here. So how do you see that market be evolved? And moving forward, what are the opportunities in Asia, both as a fundraising sort of destination as well as investment destinations?
So it's actually closer to $80 billion in capital now. But, when I moved here in 2005, it was a very early stage for what we did in private equity, which is large cap buyouts. So we had to adapt our strategy. We were doing a lot of growth investing in addition to buyout transactions. So markets like India, Southeast Asia, China was a lot of growth. And that was a change for our firm. So, probably the 3 things that we had to do differently here. Number 1, we made the decision to really localize heavily from day one. So we have close to 625 people on the ground right now, 9 offices. I have 2 expats on the ground in Asia today. It's all local hires, local executives in each of these offices. The second major decision we had to make was, do we want to raise a regional fund for our different strategies, or do we want to be part of a global fund? And I'm glad we made the harder choice of raising regional funds, first-time funds in this part of the world, because we have more flexibility to allocate capital in this part of the world and actually recruit talent who's super excited to invest in this part of the world. And the third, there are a lot of our peers who are raising country-specific funds or much more narrowly focused funds. We wanted to have a pan-Asian approach from day one. This is a very dynamic part of the world. You need to be able to allocate capital pretty nimbly and flexibly across these different countries. It's not just valuation, but it's macro conditions, it's regulatory conditions. So you're going to flex people and capital into different parts of Asia at different points in the cycle. So, you know, I actually said when we started our business in Asia in 2005, as employee number one, I said at some point in my career at KKR, Asia is going to be as large as the US in private equity. I think that's true. When I look out next 15, 20 years, when you think about China, India, ASEAN, and Japan, compared to the US as a single market, there's no reason Asia can't be as big in private equity.
So when that will be achieved? Another 10 years?
Well, if China would go a little faster, I don't know. No, Japan obviously is the big upside surprise. If you said to me, we'd be sitting here in 2024, and outside of the United States, Japan would be the second largest destination for our private equity capital and our real estate investing capital, I bet no one would have made that bet. But it is today. And I said this at our investor day, if you look at our global private equity returns in every single country around the world, our best returns are in Japan in private equity. It's a combination of low valuations, cheap financing, but most importantly, massive, massive operational improvement potential in these companies that we're buying. So, we're still very bullish about this part of the world, and we got a lot of growth ahead of us.
Thanks. Now I'll come down to my last question. In fact, this morning, actually, I asked ChatGPT what are the questions that I should ask in this group of heavyweights. And I've input every single person's name. And, I think we have more or less covered all the questions which GPT suggested. But interestingly, GPT didn't ask me to ask him my last question, which is, what is AI's impact on your business? And I would like to each of you to have a very quick answer to that. And obviously, do you invest in AI in addition to how AI impact your business? Maybe from Joe first. Yeah.
Yeah. So we are not early stage tech investors, right? That's just not what we do in terms of seed or venture. So the classic way people probably think about investing in AI, that's not what we do. We're massive investors in data centers, digital infrastructure, things that are going to be fundamentally driven by AI implementation. I would say based on the other panel we heard today, for us it's really about how do we drive productivity in our companies. We're not looking to AI to say we want a standalone investment in a growth equity bet or a venture bet. We're trying to figure out ways to leverage AI to make our businesses better.
Jim?
Yeah, I'm a little conservative on investing in it because I just remember it was 12 years from the Palm Pilot to the iPhone. Things take a little time, but it's picks and shovels. So at this point, it's going to touch everything, and we're massive investors in clean power through our sustainability, and suddenly AI is all about clean power. Who knew?
Rob?
I would echo the point that Jim made earlier on. I think there are going to be real winners and losers within the AI environment. AI as total. And so, yes, we are very, very interested in AI. We're investing in it heavily, and we are utilizing it across our portfolio. But it is about selecting, certainly in terms of the companies we're investing in, it's looking at the companies that can really benefit from AI, but the ones that actually can be taken out by AI. And really working that question out is going to be key.
Accredited investors like us don't have much to do with investing in AI at this time. We do facilities, we have a power infrastructure fund that'll benefit. I'm an old-fashioned investor, and I think real alpha is about thinking of things other people haven't thought of and getting to solutions and what I call second-level thinking. And I'm not convinced yet that a computer can be trained to outthink the other computers, which is what it's going to come down to. So I hope and believe there'll still be room for the people with the best investment insights.
Javi, last one.
Yeah, from our perspective, and this word came up, use cases came up a lot earlier. I think use cases are key. So we think about How can we invest better? How can we make our portfolio companies operate and improve better? And then how can we run the firm better? And maybe I'll just give people two super quick examples. But when rates went up and Silicon Valley Bank went out of business and the Fed was raising rates, we took all of our interest rate hedges for all of our portfolio companies and we ran them through chat. And that's not particularly innovative, but the thing that was interesting, was we said, how do you want to think? We basically said to chat, please run 10 different scenarios. And for me, embarrassingly, because even if I had chat, I wasn't the kid that was going to do that well in school. But the 10 scenarios came back, and so I said to the team, why those scenarios? And they said, see, that's what we don't know. But just assume Chad has read every finance book in the world. But, people like Howard have been running stress tests and analysis, but I bet if those tools existed, which are pretty rudimentary at this stage, you don't have a Silicon Valley Bank because those scenarios easily get run. So you can really do that. The other thing I'll say, just the other end of the spectrum, we took 50 portfolio companies, CEOs and CTOs to OpenAI last spring for 2 days. And at the end of the 2 days, I said to the group, I said, show of hands, who here thinks they've had some sort of light bulb moment in terms of how to innovate in their company that they otherwise didn't know about before they spent 2 days here with Sam and the team and Brad, and 80% of the hands went up. Now, I don't know, we're tracking all those use cases. I don't know how many of those will be real use cases, but even if it's half or 25%, it's material. And I agree with exactly what Rob said. In some cases, these are businesses that will avoid going out of business, and in some cases, they will just get much, much better. But I think underestimating the influence this will have over the next 5 or 10 years, the opportunities are extraordinary, but if you don't manage to it, I think you probably do it at your peril.
Thank you. We are completely running out of time, but I really appreciate all the time, and insight for this group of panelists. Let's give them another round of applause. Thank you.
Thank you very much for the insightful panel. Please stay on stage for a quick photo. To the middle. Now to the right, please, here at the media corner. Can we stay for another photo? Oh, please stay for another photo. We'll take another photo here. Thank you. Thank you very much. You may now return to your seats. Thank you. Thank you. Thank you very much. And now we will have a keynote. Okay. Thank you very much to all our distinguished speakers. Please enjoy your lunch, and we will have a keynote speech and fireside chat very shortly. Thank you. Ladies and gentlemen, may I have your attention to the stage again, please? We'll now welcome the Financial Secretary of the Hong Kong SAR, Mr. Paul Chan, to deliver the keynote.
Distinguished guests, ladies and gentlemen, good afternoon. Do carry on with your main course. And welcome to the Investment Summit Luncheon. This morning's program was replete with opportunity. From macro investment trends, the future of artificial intelligence and digitalization, to the vast promise of Asia and the rapidly growing private equity market. Now allow me to offer a delicate morsel of insights along with your well-deserved dessert, with a focus on the economic future of Hong Kong. You are no doubt well briefed on our current economic status, standing, and prospects. But let me supplement that with the recent developments and the favorable government policies, backed by the staunch support of the central authorities. We are creating renewed opportunities and fresh promise for you. Let's begin with trade, one of our traditional economic pillars. Hong Kong has long served as an international shipping and trade center, as well as a re-export hub for China. We have been the prime destination for mainland and overseas enterprises, setting up international headquarters to manage offshore trading and supply chain businesses. Today's global industry and supply chain is undergoing profound changes, driven by a number of trends, including, of course, geoeconomic fragmentation and the rise of onshoring and friendshoring. Our country is also undergoing remarkable transformation. That is why many mainland companies are establishing manufacturing and supply chain networks worldwide. China, however, remains a global industrial giant. It is, after all, the only country in the world to support industry in all its varying categories. It boasts a thriving technological system with research and development expenditure ranking second globally, quality workforce well recognized for its strong work ethics. So in the foreseeable future, despite the talk of China Plus strategies, China will continue to maintain a strong foothold in the global industry and supply chain. For Hong Kong, these changes are bringing new opportunities. As mainland enterprises go global, they require a wide range of services support, from trade financing, logistics, to consulting services on ESG compliance and other international regulations. They also need a platform for managing their corporate treasury, logistics, marketing, and more in support of their business development and expansion. These and related areas play into Hong Kong's strengths. Our professional services are top-notch, business and people-to-people networks are comprehensive, and our standards align with the best international standards. Our logistic capabilities are also unparalleled, with our air connectivity that allows you to reach half of the world's population in just 5 hours flight. Hong Kong International Airport operates over 1,000 flights a day, connecting more than 200 destinations, and has been named once again the world's busiest cargo airport for 2023 in terms of total volume. The free runway system, which opens next week, will further reinforce our air superiority. That is why we set a clear vision for Hong Kong to rise as a high-value supply chain management center. This is not just for Chinese enterprises, but for all the companies looking to expand their footprint in Asia. Financial services, another of our economic pillar, is also rife with fresh opportunities. Of course, we hear misconceptions from time to time about our financial services sector, including reports about outflow of funds. As a matter of fact, international investors continue to take confidence in Hong Kong, and the figures speak volume about this. Bank deposits in the city, for example, have risen by more than 13%, or $250 billion from the beginning of 2023 to September this year. Our asset and wealth management business also continues to grow, with asset under management reaching $4 trillion last year, 30% higher than that in 2018. Investors outside Hong Kong and mainland have consistently accounted for more than half of our total assets under management. So what do all these tell us? Hong Kong as an IFC is as vibrant and bustling as ever. The efforts we have been making on all fronts are building a better environment for investments, for business to thrive. In the financial world, Hong Kong's role as a super connector is also gaining momentum, linking not just with developed markets, but also emerging markets with diverse backgrounds and cultures. Here, we offer a full range of fundraising options supported by global financial institutions and talent. With the expanding Connect schemes with the mainland, both in terms of breadth and depth, across different asset classes, quality issuers from around the world could access both mainland and international capital here in Hong Kong. Shifting global dynamics are creating challenges as well as opportunities. Many mainland companies aspire to go global, will need to seek global funds to support their development of their business overseas. Hong Kong shines as an ideal platform, poised to support those goals and guide these companies on their journey into the global marketplace. And our vision extends beyond Chinese companies. The Global South, including regions such as ASEAN and the Gulf countries, is experiencing rapid growth, driven by young populations, expanding middle classes, and ambitious national development plans. Companies from these regions are looking to raise capital and expand. In face of evolving geopolitical landscape, they are keen to build stronger connections with Hong Kong, particularly with a view to tapping into the vast opportunities in this part of the world. Beyond the two economic pillars, we also have a bold vision to develop Hong Kong into an international innovation and technology hub, along with cities in the Greater Bay Area. To turn this vision into reality, we need to think big and we need to think strategically. We are building on strong foundations. Hong Kong is blessed with world-class scientific research capabilities, a vibrant startup network, and growing technological collaborations with the GBA. We focus on 4 strategic areas: artificial intelligence and big data analytics, biotech, fintech, new materials, and new energy. Take biotech as an example. We are setting up a Greater Bay Area International Clinical Trial Institute in the Lok Ma Chau area, which is along the border with Shenzhen. It will begin operation before this year end and will attract multinational biotech and pharmaceutical companies looking to access the mainland market. We are also establishing a primary evaluation system for medicine and medical devices as part of our efforts to secure, in the long term, the recognition of medicine approved in Hong Kong for use on the mainland. Realizing our innovation vision demands land. That is why we are developing the Northern Metropolis. This is where the 87-hectare Hong Kong Shenzhen Innovation and Technology Park will be located, home to many of the world's most strategic innovation and technology enterprises, driving innovation, collaboration, and growth. And we are seeking to provide for, with the park, unimpeded cross-boundary flow of talent, data, and capital. In addition, biosamples. This will turn the park into a truly ecosystem for innovation and technology relating to biotech and pharmaceutical. But more than land, strategic enterprises and talent are the lifeblood of our I&T progress. That is why we have launched a range of initiatives to attract the best and the brightest from around the world. And the results are encouraging. Some 100 I&T companies from around the group have been attracted to Hong Kong with investments totaling $6 billion and creating more than 17,000 jobs in the next couple of years. But it is not just about companies. It is about people as well. Our talent schemes have been met with overwhelming response. With nearly 400,000 applications received today. We have approved about 250,000 of them, and about 160,000 professionals have already arrived in Hong Kong. Meanwhile, to add to the impetus of our I&T development, we have set up the Hong Kong IC, Hong Kong Investment Corporation. As patient capital, the Hong Kong IC has a dual mandate, seeking reasonable financial returns, of course, while enhancing Hong Kong's competitiveness and economic vitality through strategic investments. Through investing and co-investing in projects, it plays a key role of supporting Hong Kong's strategic industries and the development of the different parts of the related ecosystem in the industry chain, as well as channeling private capital to the sectors that we want them to go. The Hong Kong IC has already concluded a number of exciting projects, from using AI for drug discovery to exporting electric vehicle charging systems to Thailand. It is helping to drive our innovation agenda forward, and we will be seeing the impact it will make in the coming few years. Ladies and gentlemen, I hope I have given you a glimpse into the exciting future that Hong Kong awaits you. We are a city that has always tried on change and challenges, and we are confident that though the sailing can be fraught with uncertainty, we will, as always, weather the challenges that lie ahead and emerge even stronger and more vibrant. Under the one country, two systems principle, Hong Kong will always remain open and welcoming, harness its singular strength in internationalization, and committed to working with you all to build a brighter future. I know you all will enjoy today's luncheon and the accompanying fireside chats. Thank you very much indeed.
Thank you, Mr. Chan, for sharing your vision. Most of our audience here know Hong Kong as an international financial center, but Hong Kong is also an important trade and innovation hub in the region. Just as our financial market serves as a barometer of the performance of neighboring economies, what goes on in Hong Kong's economy is also a gauge of some important traits affecting the broader region. Our fireside chat will explore key themes shaping Hong Kong as well as the region's transformation. May we now welcome our moderator, Laura Cha from the Hong Kong Stock Exchange, Victor Fung of Fung Investments, and Joseph Chai of Alibaba. Thank you, Laura. Over to you.
Good afternoon. Welcome, everyone, and thank you for staying through lunch and to this fireside chat. I'm delighted and very pleased to have two good friends of mine and who are esteemed experts in business, finance, technology, and trends that are shaping the global economy to join us for this fireside chat. They hardly need any introduction, but very briefly, many of us know that Victor is a prominent industrialist who has led successfully one of the world's largest trading companies. And before that, he was a professor at Harvard Business School. This, not too many people know. Joe, at the same time, has been admired for his journey from a lawyer to private equity investor and, of course, co-founding Alibaba. And he is recently known to be a sports investor and is the proud owner of a sports team. So we have heard this morning the different, how should I say, the global economic landscape in the face of growing populism and political polarization. We are in a world where the economic policies are now very much shaped by geopolitical considerations, competitive rivalry, national security, and the list goes on. And we are in a world where, with the incoming Trump administration, I think there will be more uncertainty to our world order. Uncertainties in terms of shifting geopolitical tensions, uncertainties in the sense of more advanced technology, and with the breathtaking development in AI and technology, there will be more variables in the world order. But we know at the same time that, as the title of this year's summit suggests, we have to sail through changes. So a lot of the talk about global economy now have centered on decoupling, deglobalization, and de-risking of supply chain. We will explore, are these really what's happening? And what does that mean for global economy and for Asia's economy and for Hong Kong's role as a center for international finance and trade. So, Victor, with the global supply chain experiencing significant changes due to tensions, due to technology advances, and shifting customer expectations. As a global leader in supply chain management for decades, what challenges have you observed, and what do you foresee the supply chain reconfiguration will mean?
Thank you very much, Laura. First of all, I really like to say how happy I am to be here, see so many friends and familiar faces, and really to thank the HKMA for bringing all of us together. This is absolutely a time of dramatic change for the world supply chains. And to me, the changes in the supply chains really symbolizes the change in the global trade patterns and the global economy. Let me just say that, you know, this one thing you see in the landscape today is really two things that you really must recognize for a global trader. First of all, the geopolitics. It is what it is. You know, we are all working very hard to make it better, but I don't think that many people are thinking that the geopolitics will change, and hopefully it won't change for the worse as we see it today. So that's really one reality that is going to be affecting all of us. The second reality is we all talk a lot about how Asia is going to really be the future. Yes, but actually for the global trader, it hasn't happened yet. The consumption around the world is still in the US and in Europe. The last I read is that 46% of global consumption are still in the US and European markets. So if you look at then what's happening in supply chains, the reality is the following. It has always been, for the last 20 years, China was the world's factory, made in China, shipped to America, shipped to Europe. Those are the major principal trade lanes, bar none, right? All the rest dwarfs in relation to these trade lanes. However, with these two realities, it is now very difficult to continue this model. So what is really happening, and happening very fast, and I would say in a dramatic way, is what's the adjustment? Really, what people have been doing now is really taking the components that are still made in China, shipping it to a third country like Vietnam, doing the last stage of assembly, usually the labor-intensive portion, and under strict WTO rules, have enough local content to get a designation made in Vietnam. After you get that designation, then you ship to US and Europe. So you can see that you don't just do this for Vietnam alone, right? You do this for 40 countries in the developing economies. So you can see what's happening now is a total fragmentation of the world supply chains. And really, that is the adjustment that the world is really seeing. Now, on the technology front, Laura, you know, really, the impact of the technology, which has been coming on for a period now, is really enable the supply chains and the manufacturing to be linked much more to the final consumer, what we call end-to-end supply chain. And as the consumer really demands faster and faster response, what you're really seeing is the lead times, the cycle times really shortening. We used to take 6 months from the time a product is conceived to the time the product reaches the consumer. Now it's 4 to 6 weeks or less. So you're really seeing a lot of very maybe small lots, but very fast shipments. And what that really means is that the response time, because of the use of technology, is much, much faster, and you're much more really attuned to the mood of the consumer. And in terms of the global transportation system, there is absolutely a movement towards using air. Because if the consumer wants the product, as Joe knows very well, after ordering in the next 24 hours, 48 hours, you've got to move those products very quickly. So this is really how I see the whole setting of the scene now in the global supply chains and hence the global economy.
Thank you. Joe, Alibaba operates the world's marketplace. And as Victor said, you know, the supply chain has been reconfigured with the technology and so on. It really has moved very fast. And you are also at the forefront of cutting-edge technologies, including AI. So how are you seeing the changing global environment for trade, finance, and technologies? How did that converge, and how does that impact on your business?
First of all, I want to thank Eddie and your colleagues at HKMA for giving me the opportunity to share with a lot of friends in the audience. And also an honor for me to share the same stage with my good friends Laura and Victor. You're not just good friends, but you're mentors to me. So, to your question, before I get into AI, I want to talk about trade a little bit, because one of Alibaba's businesses, besides our cloud computing and AI business, is a e-commerce marketplace. We actually run a global marketplace. And I want to echo Victor in his remarks that the global supply chain is actually fragmenting. And it is, if you look at what's happening from a macro standpoint, China is about 30% of global manufacturing value add. So when you think about shifting some of the component assembly and things like that to Vietnam and other countries, what's happening is you're reallocating the manufacturing value add to some of the other countries. Now, is that terrible for China? I think in the short run, it definitely hurts Chinese exports. But I think in the long run, it actually helps some of these developing economies grow. Because China's history is it grew as a manufacturing powerhouse, and that's why today it has 400 million middle-class consumers that are buying stuff from around the world. And you look at countries like Vietnam, Indonesia, what's going to happen is as they move up the value chain, their populations are going to become wealthier, and they're going to be able to buy stuff from around the world, including from Chinese exporters. So I think there is a circular effect that's going to be beneficial ultimately for China. Now, having said that, I don't believe that the Chinese manufacturing base it's being eroded, but I don't think it'll wholesale move out of China. Just the sheer size of the labor force in China, even though with a declining population, the Chinese labor force is becoming more and more productive with automation and AI and highly educated, very industrious labor force. You can't find a place with 800 million people who are in the labor force that's ready and willing to work very, very hard. So it's very hard. The other thing is a lot of the upstream supply chain is still in China. So you can't just move one factory. You have to move like 40 factories around it. I recently visited one of the factories. They sell direct online through Taobao, our e-commerce platform. And this factory, they make smartphone accessory stuff, like your glass screens on the smartphone. And it's an entrepreneur. He's only something like 35 years old. He started his factory. Now he's making 2 million screens every day. Wow. And so what he tells me is, when he decided to start his own factory, he sent through his chat group and say, I'm going to do this. And immediately within the same day, a lot of his friends came and said, oh, I can offer your sourcing of raw materials. I know a place to buy manufacturing equipment, all made in China. So the upstream supply chain is still in China. Yeah. So think of a country where you can just plop yourself down and say, I want to do a iPhone accessories factory, and then everybody comes around and say, I can supply this, I can give you manufacturing equipment, I can do it. No other country can do that. So the supply chain is quite deeply rooted in China still. So I think it's going to be a slow process of diversifying the supply chain.
Yeah, I think we heard this in previous panel about China plus one, and both you and both Victor and Joe have already explained how that China plus one work. The key is China is still there. It's not, although we talk about reshoring, friendshoring, etc., I think it is very difficult to write China out of the equation. At some point, China will still be featuring in the manufacturing sector. But Victor, what does that mean, considering Hong Kong's strategic position has always been the center for international trade and finance? With this shifting landscape and reconfiguration of supply chain, where do you see Hong Kong should be positioning to go forward?
Okay, before I answer that question, I just like to build on something that Joe just mentioned on the supply chains. I think the movement is not really a hollowing out process. What we're really seeing is a downloading of the labor-intensive portion of the whole production process, as you were saying, Joe. And really, what is happening now is the supply chains within China itself are really trading up the supply chain to really focus on the upstream, and which is much more technology and capital intensive. So really, I see that as an economic specialization process. And that's actually, I think, very important to note. Now, the other point is, for the recipient countries, these developing economies, I think it's going to be a huge boost. Because many of these economies really need the opportunity to get into the global supply chains and to use their labor in a meaningful way, in a proper way, and to really then bootstrap themselves up the process. In fact, if you look back at the history of the Chinese economy's development, that's how China bootstrapped itself to the economy that you see today. So I think this is bringing in my mind, a new wave of globalization. Very, very far from the idea of decoupling, very far from the idea of deglobalization. In fact, it is a new wave of globalization. It is actually a different type of globalization.
I think, first of all, I agree with you. It's really not deglobalization, perhaps it's reglobalization, or even when people talk about regionalization, there has to be connectivities. And I think one of the beneficiaries of de-risking from China, as some of the commentators have said, it really is the global south. We talk about ASEAN, which is an important part of the ecosystem and also the beneficiary of moving supply chain, part of the supply chain from China. But also, if we look at South America, Mexico, also a beneficiary of what we have been termed de-risking. But let me turn a little bit to Alibaba, to Joe. Joe, your IPO, Alibaba's IPO on the New York Stock Exchange in 2014 was the largest in the history of the United States stock market at the time. And I'm pleased to say that Alibaba has recently also changed its secondary listing in Hong Kong to primary listing. Perhaps you can share with us your consideration behind that, and how do you see Hong Kong continue in that journey to attract more company to be on the primary listing side?
Yeah. First, our journey, we were listed on the New York Stock Exchange in 2014. And then during COVID, it was 2020, we came to Hong Kong and did a secondary listing. Just recently, as you mentioned, last couple of months, we switched that secondary listing to a primary listing. And the main advantage of having a primary listing in Hong Kong is that you get access to mainland investors through the Stock Connect program. This is an excellent program where mainland investors can basically invest their RMB and they come in and buy Alibaba stock, and their money stays in the system. So it's a closed loop system. So which means when they sell, they still have to ship the RMB back to back to China. But it actually opens up our ability to attract our mainland investors. And guess what? 90+% of our business is in the mainland. So we have our customers and users who are familiar with our products, but not familiar with our stock. Now they can access investing in our stock. And just within a couple of months of us attaining this primary listing status through the Stock Connect program, about 4% of our public float now are owned by mainland investors. But guess what? 15% of trading volume is from these mainland investors. So almost 4x of trading volume than their shareholding. So they bring a lot of liquidity into us, and that's one of the great benefits of having being listed on the Hong Kong Stock Exchange, being able to tap into the global investor base, but then also getting access to mainland investors.
I think that's a very important feature for companies that are listed elsewhere in the world and other markets, come to Hong Kong originally as a secondary listing and then change to a primary listing. A year ago, the mainland authority also allowed primary listed foreign companies in Hong Kong. In other words, you do not have to be like Alibaba or any of the red chips, but the foreign companies coming to Hong Kong and list as a primary listing, you can also enter into the Connect program and therefore access the huge number of retail investors in China and thereby increase your liquidity. Victor, over to you.
Well, Laura, let me get on to your question about the world that we have just described. What does this mean for Hong Kong? I think first and foremost, Hong Kong has always had the tradition of intermediating trade, right, in the region and to and from the mainland and so on. What is happening as the global manufacturing process disperses? Okay, Hong Kong is really doing the role of what I would call control tower in terms of moving the production around. And that is absolutely an essential role. That's really real economy stuff. And, also this flow is not like just one thing flowing to another and then it's static. In fact, what we're really seeing is this movement of manufacturing around the different countries and so on around the world will flow back and forth based on the geopolitical environment. When that environment changes, that's going to move. Now I think the main flow is actually from the mainland to Southeast Asia. But I think from there, people will be flowing further into South Asia, into the Middle East, to Africa, etc. But at the same time, because what you mentioned earlier, the French shoring and things like that, we're seeing jumping to what we call, nearshoring, and basically markets that could serve the two big markets of US and Europe. So Mexico is benefiting tremendously as a jump. And then I think in Europe, Turkey would be the nearshoring market because you can truck into Europe from there. If the geopolitics change, this will also shift. And as capacity usage changes, things will also shift. So Hong Kong's role as a control tower, first and foremost, I think is crucial. The second point, I think, is really thinking of some of the needs of Hong Kong, of the people going out, and using Hong Kong as the base. I think the first wave of movement actually will be primarily by the medium-sized enterprises from China. And they don't know these, developing economies, and Hong Kong really can be a guide to actually help them with that movement. That's going to be a big movement. From there, I think there will be movement of middle-sized companies from around Asia. And then in the long run, I think we have to keep an eye on India and its medium-sized companies moving around. So I think the idea of Hong Kong as a place where you can actually use as a hub, as a launching pad, I think is going to be our second role. And then the final thing I would say, Laura, is one of the biggest pain points as these medium-sized enterprises, move around the world with their production. financing is going to be key. And I would start with trade finance, because that's certainly one part of the overall package that's crucial. And that's probably the easiest for the financial sector to get into, because if a small factory sells to Walmart and you buy that receivable or secure against that receivable, I think it's pretty good. So you can start there, and then that'll go from there to loans, to equity, etc. And I think Hong Kong has a real role to play as the financing of that. And also, that's really merging Hong Kong's two great strengths, the supply chain center concept and also the IFC. And in fact, I would come back to the message that I know many people have given, and that is, how do we strengthen Hong Kong's position as an IFC? And I think what is happening with this movement as we merge these two, there'll be two things. One is the IFC will be anchored a lot more in the real economy and true flow of goods and economic activity. And the second is, I can see Hong Kong playing a role as a major trade finance center, which is something that will actually be very necessary to fill the very large and increasing trade finance gap in the world, which the ADB has actually did a major study last year to say it's $2.5 trillion today and increasing.
Thank you, Victor. I think the small, medium enterprises are really the backbone of many markets, China included, and then Hong Kong itself, and all of Southeast Asia in particular. In recent years, in the last 2 years since COVID, we have heard a lot of the financing need of SMEs in the region. And that is certainly something that can be further developed in Hong Kong. We have often emphasized on the public market side of Hong Kong's aspect as an international financial center. But as you say, trade finance is an important aspect as well. Joe, if I could turn to you about shifting to AI. I know that Alibaba has you've recently said that Alibaba is AI and beyond, and everything is on AI a lot. So not only Alibaba not only develops, but operate a really rapidly growing cloud and AI business. Can you share some of this with us?
Yeah. I would like to say first that AI and cloud are like hand in glove. There's a symbiotic relationship between the two. And that's because when people use AI, whether it's training large language models or applications in the industry we call inference, you have to use computing power. And this is the reason why Microsoft invested in OpenAI. Because they want to grow their cloud computing business. They were somewhat behind AWS, and then they decided that AI was going to be the main driver of their cloud business. And then just think about it. Someone mentioned today that 200 million users of ChatGPT. Every time someone puts in a query into ChatGPT, it's thinking, the brain is thinking behind it, the computing is running, and it's running on Microsoft cloud infrastructure, and they generate revenue from doing that. So that's the logic, and we run both. We have both. We are the largest cloud company in China by far in terms of share and also technology, and that's because we invested 15 years ago in cloud technology out of our own necessity, because we were seeing an explosion of data and digitization of data coming into our e-commerce business. And that's why we invested in the basic fundamentals of cloud. And so, so with AI, we also run our large language model, which that's why I say it's hand in glove, because anybody that uses the Alibaba large language model will need to have compute, storage, networking, security, and all of that runs on our cloud. And we have already open sourced the 72 billion parameter large language model, so anybody can have access to that. We have an open source architecture. Yep.
I think everybody can see that AI is an area where China and the US will be competing. And it doesn't matter who is more advanced. I think, you know, right now, China is trying to catch up, but I think there's great potential. You know, and here in Hong Kong, we continue to play the connecting role, and we hope to be in playing the financing aspect, right? But as we look at the next decade, what is the prospect? If we started out the conversation about decoupling, the globalization, and so on, what do you think each one of you would think about the prospect of decoupling in general? Is the word going to go out of fashion soon?
I guess prospect of decoupling is kind of an oxymoron. Prospect is positive, decoupling I think is inherently negative, a negative trend, because it makes things a lot more inefficient. But where I see, from my vantage point, decoupling is felt most acute in the semiconductor area, because the United States government has decided to restrict the export of high-end chips. But not only the chips, final product itself, you know, NVIDIA chips, but also manufacturing technology and lithography technology. And these are, you know, manufacturing technology is the leading example is TSMC, and the Dutch make the lithography equipment, and that's even subject to restriction, and the restriction is against China. So now you are forcing a decoupling of Chinese forcing the Chinese to self-develop their semiconductor manufacturing. Now, I don't see any light at the end of the tunnel, so I think the trend is going to continue to decouple in the next, let's say, 4 or 5 years. But beyond that, people are going to all of a sudden realize, wait, this is kind of silly. Now, for 2 reasons. Number one, in the area of AI, it is so expensive and time-consuming to develop AI technology. And you're seeing American companies pouring in massive amounts. And we're talking about $100 billion worth of data centers. John talked about that. The question is, how are you ever going to make that money back? And there's you know, it can't be that this is not a sustainable situation. So I think countries will have to work together. Between US and China, they'll have to work together to develop some kind of AI. And the second thing is, the second reason I see some kind of convergence is the world is not just about US and China. Yeah. There are a lot of other countries in the world. You know, I was talking to the AI minister at the UAE. They're developing their own version of AI. And they all need to get access to somebody's technology at some point, and they're not going to choose. They're not going to choose, I'm using American or Chinese. They're going to do both. And that'll give an opportunity for both countries to further develop their technology. So I think over time, people will just say, this is kind of silly. Let's get rid of the barriers. Let's converge. Yeah. Otherwise, it's too costly.
Yeah. Laura, I certainly agree with Joe. You know, when you're talking about the, you know, cutting edge development of AI and at the top, I'd like to offer a slightly different viewpoint on what's really happening on the ground. If you think about it, without AI and all this technology, I think the linkage of the manufacturing with the consumer will never have happened the way it did. So in a sense, if you look at the working level, the practical on-the-ground level, this technology has actually brought people together as opposed to decoupling. In fact, I would say the technology, AI especially, has enabled a stronger coupling. Now you link the factories and markets together, you know, in split seconds. And then the other thing I would say is, if you look at the, you know, the major issue that all of us are thinking about in our daily lives, sustainability. Without the technology, without the, you know, all the things like blockchains, etc., without AI, I think we would never be able to tackle the issue, which is what we're tackling, which is really looking at the whole area of traceability to actually do something about the sustainability issue. And going to our tier 2, tier 3, and tier 4 suppliers to be able to trace the whole journey of a product all the way from the farm to the consumer. And that, I think, is the ultimate long-term solution to actually controlling the sustainability in the world.
I think that's very well said. I think, on everybody's agenda, all the corporate agenda, sustainability is here and it's getting even more prominent. This morning, the Vice Premier talked about, the high level of opening up, a high quality productivity, and where Hong Kong can fit in, and where Hong Kong can fill the needs of China, of the country's demand, and at the same time for the country to lean on Hong Kong on the international financial center aspect. I think we will all agree that, Hong Kong will continue to have a role to play, whether in reglobalization, fragmentation. Our role as a super connector is important. I think technology will play a big part. The SAR government is catching up on that area. But I think overall, I would say we are hopeful that decoupling may not, in a sense, will not last. It continue to happen. We have to deal with it. We face it. But hopefully, it will not last very long. With that, can we give a big hand to our two panelists?
Thank you very much, Laura, Victor, and Joe. Please stay on stage for a quick photo. To the center. Thank you, and to our right corner over here, please. Thank you very much. You may now return to your seats. Thank you, everyone. The summit is coming to an end. May I now invite Mr. Eddie Yu to come on stage for a closing remark.
I'll be extremely brief. Well, first of all, thank you very much to you all for coming to this event and staying from 8 o'clock in the morning till now. We really appreciate that. And I hope that you have enjoyed the dialogue today as much as I did. And my special thanks to all the speakers who made the dialogue so interesting. In fact, this kind of dialogue is exactly the type that we will want in times of change like this. So next year, we're going to do the summit again in the first week of November. We've already identified two very nice venues for you, for both the dinner and also the summit. So do come back. Remember the first week of November, and we'll send you the invite early. Thank you so much.
Housekeeping remarks. For those of you who are joining the conversation with Global Investor Events tomorrow, please note that it will be held at the Hong Kong Exchange Connect Hall. For those of you who are joining the conversations with Global Investor Events tomorrow, please note that it will be held at the Hong Kong Exchange Connect Hall. Thank you.